very warm welcome to each one of you. On behalf of Bangalore Chamber of Industry and Commerce, we welcome you all for this two-day International Tax Conference organized under the aegis of Direct Taxes Expert Committee. The expert committee is chaired by Mr. Sunil Dhareshwar, EVP and Global Head Taxation of Infosys, co-chaired by Tapti Ghosh, partner from Deloitte, and Mr. Sriram Ranganathan, VP and Global Tax Head Wipro, and mentored by Mr. K.R. Sekar, past president BCIC and partner from Deloitte. On behalf of BCIC, we express our sincere thanks to all the distinguished speakers for accepting our invitation to address at this session. Now, I would like to hand over the platform to Mr. Sunil. Over to you, sir.
Rupa Shekar's joined, so Sekar will do the opening address. Sekar,
okay.
Over to you.
Thank you. Sorry, Sunil, all members, I'm not coming on video. Sorry about that. First, thank you so much for all of you for joining this two-day virtual international tax conference. Actually, Bangalore Chamber of Industry and Commerce started this event when my good friend K.R. Girish was the chairman of the Direct Tax Expert Committee way back in 2000. And we have been doing this for the last 2 decades on every year, barring 1 or 2 years we missed it, but we have been doing this every year. This is one of the important events in our calendar by which we organize sessions on very important and latest topics on international tax, participated by various great speakers. And the idea of this conference is that when I can still remember, because when Girish was a chairman, me and Girish used to discuss that why Bangalore cannot have a class of an international tax conference, and that was the reason Girish started in 2000, and we still continue that. The idea is that to have a class of an international tax conference with a galaxy of all India speakers talking and discussing on various important subjects. And this year also we have phenomenal speakers, starting with Mukesh Bhutani, K.R. Girish, moderating with Hitesh Gajaria and Amit Gupta. Great professionals, and all the young professionals can learn a lot out of them. Followed by session on angel tax moderated by Sunil Dhareshwar. Followed by session on Sriram Ranganathan on global, Pillar 1 and Pillar 2 approach with Shikha Gupta and Nitya Srinivas. Then tomorrow we have a session on a special session by N. Venkatraman, Additional Solicitor General. We have an exclusive litigation support, exclusive litigation issues by S. Ganesh. Then we have a session on latest on tax technology. When I mean tax technology, not the clear tax side, but it's predominantly on cryptocurrency, e-commerce taxation issues. Then we have transfer pricing trends and practices. So on the overall, it's a great conference with great speakers. And we also invited Principal Chief Commissioner of Income Tax, Ms. Madam Priya. Unfortunately, she's traveling, but she has given a video clipping of her speech, which will be relayed by the Bangalore Chamber of Industry and Commerce. And we have the President, Mr. Devarajan, here. Thanks to the Chamber's support and the team support, we are able to organize this. And ladies and gentlemen, I would like to assure you one thing, that this conference, what we propose under the aegis of Direct Tax Committee, supported by Sunil, Tapti and Sriram, is a class conference. And I'm sure every one of you will be learning something, and there'll be a key takeaways from me for each of the session. With these few words, I welcome you all for this. And though we wanted to do a face-to-face conference, but because of constraints, we are doing it virtually. I'm sure the next year we'll be having a face-to-face conference or a period of 1 day or 1.5 days, depending upon how it goes. And finally, I thank Sunil Dhareshwar, Sriram Ranganathan, and Tapti Ghosh, who, despite their busy schedule, were able to support it. I'd also like to mention that Bangalore Chamber of Industry and Commerce, as represented to the central government on various matters relating to the international tax, transfer pricing, and direct taxes, and all the recommendations have been well received, and I would not say accepted, but have been well received and being discussed by the Ministry of Finance with all the members of the expert committee. Thank you so much, Sunil, Tapti, and Sriram for doing this. Back to you, Sunil and Rupa. Thanks a lot.
Thank you, sir.
Thanks, Shekhar.
Now I'd request our President, Dr. Devarajan, to set the context. Over to you, sir.
Yeah, I think good afternoon, everyone. Good afternoon, all the members and participants. And Shekhar already set the context into this. But I'd like to share a few of my thoughts, which is important for us to understand. Definitely, India is the fifth in the world in GDP, going forward to become number 3 by 2030. Exports is the major critical growth in the last few years. I think if you see the export to import ratio growth, it's been growing at 35% last year compared to 18 and 20% in the previous years. So India has a market in India as well as international business, and direct taxation and the key exports areas in which we are talking today is very, very apt for all of us in all the industries today, whether it's automobile industry, any industry you take, where the exports are growing. And I represent TVS Motor, which I find the exports bringing a big amount of expertise, and a lot of changes are happening in exports also. A lot of localizations are requested in that country. The transfer pricing, the changes requirement in the laws in this country, and we have to be very, very clear because everyone is catching up on this. If you really see China plus one strategy, we have to be competitive both in local market and in international market in this today current situation. And as what Shekhar did mention, this is a flagship event, and we like this to happen as a face-to-face in the coming year. What I liked about this approach, which will help all of us to understand, is almost like an all-round approach, like a global development of taxation, international business, India in the global field, startups and financial bills, which is very, very important, new way of accounting, new way of cloud computing, transfer pricing, litigation. I think you have covered all the areas, and all of us will be really eager to learn and try to apply in our own area. Another thing is I like to thank all the expert committee members, like what Shekhar did mention, leading by Shekhar, Girish, Sriram, Dareshwar, Srinivasan, Shankar. All, I think, thank you very much for your excellent contribution. Request you to contribute further on this. And probably we can make a paper out of this and bring it into an e-Synergy magazine, which we bring every fortnight or a month. Some of the articles would definitely help all our members to take it forward. Once again, thank you very much and look forward the coming year. This is an interesting session, definitely. And face-to-face would be a great help for all the members. Thank you very much, and over to you. Thank you.
Thank you, sir. I would now request Mr. Sunil Dhareshwar to take it over from here. Over to you, Mr. Sunil. Thank you.
Thank you, Rupa. Shekhar has already, said the opening remarks and set the tone. I'd like to, thank everyone who has, joined today, being a Saturday evening, having taken time out, all the participants as well as all of the speakers for having taken time out to join this conference. Like both Devarajan and Shekhar mentioned, we've lined up some very interesting, topics across different areas of international, tax, and some of the most emerging and relevant issues that we face both in profession and in industry. So I hope the next 2 days, which we have between today and tomorrow, we have some very interesting, panel discussions, thought-provoking questions that come in the panel and from our attendees as well, and the takeaways that are relevant to what we do on a day-to-day basis. So I look forward to an interesting and engaging discussion over the next 2 days. I'd like to thank both Tapti and Sriram for everything that they've done in terms of putting this together. For all of our speakers, panelists, and guest speakers who have agreed to speak today and tomorrow, and to the BCIC team for the support extended in putting this conference together. With that, Rupa, I hand it back to you, and we can get started with the conference.
Thank you, Mr. Sunil. Now I would request Ms. Tapti to take it over from here. Over to you, Tapti.
Thanks, Rupa. Thanks, Sunil, and thank you, Dr. Devarajan. Congratulations once again on your appointment as president of BCIC, and all the best.
Thank you.
A lot of context has been put forth. So without much ado, it's my honor to introduce Ms. Preeti Garg, an Indian Revenue Service officer holding dual charge as CCIT TDS Bangalore and CCIT International Tax South Zone Bangalore. In the past, she's held positions covering the Northwestern region, Karnataka, AP, across multiple roles: CIT DR, CIT Appeals, Principal CIT, Central, Visakhapatnam, Hyderabad, Bangalore. She's done courses at IIM Bangalore and the Maxwell School of Public Policy, USA. She wasn't able to make it today, but she's been gracious in giving us her keynote address, which I'll request Rupa to play.
My greetings to all. I'm very happy to note that the Bangalore Chamber of Industry and Commerce is organizing a 2-day virtual conference on international tax. The topics included for discussion are of immense relevance for international tax and transfer pricing. The global economy today is witnessing unprecedented changes, and tax systems must adapt to ensure fairness, transparency, and sustainable growth. The Finance Act 2023 has also brought about significant changes. In this backdrop, this conference would provide a platform for discussion and exchange of ideas. All the speakers are public figures and renowned in their fields and domain knowledge. One of the most significant trends in international taxation is the rise of digital economy. The proliferation of digital transactions and cross-border e-commerce has created challenges in allocating taxing rights among countries. With digital business transcending geographical boundaries, governments are facing the task of effectively capturing revenue generated from digital services and products. Base erosion and profit shifting are issues. As part of BEPS Plan 1, equalization levy was implemented in India to ensure that multinational digital companies operating in India pay their fair share of taxes on the profits they generate in the country, even if they do not have a physical presence there. The challenges remain: countering harmful practices, countering tax treaty abuse, TP documentation and country-by-country reporting, and improving dispute resolution mechanisms. Global minimum tax, OECD Pillar 2, seeks to counter competition over corporate income tax through the introduction of a global minimum corporate tax rate that countries can use to protect their tax bases. As regards transfer pricing, while the department seeks to determine the correct arm's length price, the taxpayer in return seeks tax certainty. In order to ensure a correct balance, the objective of TP documentation outlined in the BEPS Action 13 report must be kept in mind. That is, to ensure that taxpayers give appropriate consideration to transfer pricing requirements in establishing prices and other conditions for transactions between associated enterprises and in reporting the income derived from such transactions in their tax returns, and also to provide tax administrations with information necessary to conduct an informed transfer pricing risk assessment. Insufficient documentation makes TP audit a challenging task. It would therefore be in fitness of things to ensure that more comprehensive data and disclosures are maintained and submitted to the TP officers in terms of AMP spend, intra-group services, cost contribution arrangements, valuation of intangibles, deemed international transactions, loan agreements, to name a few. Further, In the interest of tax certainty for taxpayers and reduced litigation, there is also a need to urge more taxpayers to come forward and opt for safe harbor. Presently, MAP and APA programs provide effective dispute resolution mechanisms. Financial year 22-23 saw a record of 95 APAs and including 31 bilateral APAs being signed. However, in comparison, the number of assessees opting for safe harbor is very less, although safe harbor provides an efficient and effective means of enhancing tax certainty and avoiding litigation. The Finance Act 2023 has brought in non-resident investors within the ambit of Section 56(2)(7)(b). This has led to a lot of concerns. The scope of angel tax exemption is expanded. All these are relevant topics which would be discussed in the conference, I'm sure. I wish you all the very best and would like to thank the organizers for giving me this opportunity of putting my views across. Thank you.
To our first panel, which is going to be moderated by KR Girish. KR Girish needs no introductions in a BCIC event.
Tapti, before KR Girish, Mukesh Bhutani has special lecture. Girish moderation, I hope you have the agenda.
Yes, I have the agenda.
Yeah. Okay. Sorry, Tapti.
Yeah, and Girish would take it forward with introductions for Mukesh Bhutani and so on, Sekar. So a quick introduction to KR Girish for the sake of due process, because for
so I think Tapti,
yes.
Just to pause you here, it's probably not required. We can directly delve into this thing. A lot of people do know me, and then I think
absolutely. It's just a due process.
I think Sekar has already done a brief introduction, so let us go ahead with that. And I think if you don't mind.
No, not at all, Girish. Maybe you could take over the next session as a moderator, Girish.
I think Tapti, is Mukesh's talk comes now, or we'll start with the panel?
It does.
You start with Mukesh. You start with Mukesh, Girish.
Yeah.
Okay.
Let me in that case.
So I would then request Mukesh to give his keynote address.
Thank you, Girish. Thank you, Sekar. Thank you for inviting me. I'm just going to share my presentation. This presentation I put together recognizing very well that there are some interesting sessions. Can everyone see the presentation?
Yes.
Yeah, now we can see you, Mukesh. Yeah.
I saw that there are some very interesting technical topics, particularly on the contemporary debate on Pillar 1, Pillar 2, digital taxation and everything. So I just thought I will just give a kind of a 10,000 feet view, really what's happening in international tax, covering as much as possible in the allotted 20 minutes that I have. And Girish, don't hesitate to stop me in case I'm exceeding my time limit. So the key themes are a bit of an overview, what's happening really at the global level, particularly in the last few months, and what's likely to happen in the future. We should bear in mind that both India and United States are moving into a election cycle, and tax is inextricably linked to the politics in both the countries. A debate that often gets ignored is UN and India's engagement with UN. There are some very interesting developments that I wanted to talk about. This is also an indication of things to take shape. And then finally, EU, particularly the anti-tax avoidance directives that come into effect, and really what are the key stakeholder concerns that large businesses have expressed in relation thereto. Quickly on the overview, we all know that the post-COVID recovery has been kind of patchy all across the world. In India in particular, we have been lucky given the growth rates that we experienced in financial year 22-23, but we are experiencing a slowdown again in 23-24. But on an overall basis, the tax agenda is driven by one simple figure, which is a $3.305 trillion of global debt that has got accumulated all across the world. And that's kind of, resulting in a political stance how to mobilize tax revenues, which has become a consistent, talk amongst politicians in most major economies. Unprecedented developments happening at a very fast pace. Some of them that I wanted to talk about was the global transparency and exchange of information, now record 168 members. This number was hovering around close to 100 or even less than 100 before COVID. So there is a catch up even by many other countries. Some of the other developments include, though the common reporting standards date back to 2017, but the implementation is something that is becoming the focus area. And then the crypto asset framework, which was announced also recently. There has been a fair bit of request insofar as issues like beneficial ownership is concerned. Some of them are driven by revenue, some of them are driven by capital markets regulators, so on and so forth. And then finally, the mutual administrative assistance in tax matters. Again, a record 130 countries are becoming a part of it. There is a debate on shift to multilateralism, which is the largest issue. However, this is...
Sir, can I interrupt, sir?
Yes.
The slides are not moving. I just wanted to check with you.
I am still on the first slide.
Okay. Sorry, sir. Okay.
Yeah. There is a shift to global multilateralism. However, tax as a sovereign function is becoming a key area of development. On other OECD developments, the two-pillar, debate dominates it. I'm not going to get into that because there is a session specifically covered in that. The CBCR and the EU directive deadline is coming very close. You will see many of the EU nationals now being forced to embrace the public CBCR requirement in the national legislation. There is a separate set of reporting requirements applicable to listed companies within the EU. We've also seen an increasing trend amongst large corporates on the tax transparency as a prominent feature appearing in their annual report. Amazon, Microsoft, Cisco, ExxonMobil annual reports for 2022 calendar year are some of the notable examples. UK is completing close to now 5 years of the diverted profits tax. This was a major reform undertaken by one of the most developed economies when the world was debating unilateral levies way back in 2017 and 2018. There is a fair bit of debate on the UK's diverted profits tax. Nevertheless, UK has demonstrated that there is a substantial increase in the amount of collections that they've experienced on the diverted profit tax. Bloomberg reported that today the globe has 40 different kinds of digital levies. So what we see as equalization levy is just one form, but there are 40 levies all put together. Carbon tax and green tax is assuming another importance in the new paradigm, and 35 countries have looked at a carbon tax mechanism. On the multilateral tax debate, I know we have Pillar 1, Pillar 2 debate coming up. I just thought that I will explain it with this slide. Debates that are happening, which may be converging, which may be diverging in some shape and in some form.
Mukesh, Sunil, you're still on the first slide, which is the opening slide. So I'm not sure if you have, because you said you wanted to go to a particular. Right.
I am.
You can put it into the slideshow also, if possible. Yeah.
I'm just trying. I mean, I'm having a screen which says stop sharing. So I would imagine that. Just give me a minute.
Yeah, we are on the slide which now says multilateral tax agreement, current state of affairs, OECD.
Yeah, I know.
US.
Okay, if you want, you can go ahead with your flow and then send this presentation later to us. We can circulate it, Mukesh. For a person like you, don't need slides. You can talk without slides.
Okay, fine. So let me move with the flow, and I'm sorry about this.
You move with your flow. You move with your flow, and then send the presentation.
Let's go ahead, Mukesh. That's fine.
Thank you. So, on the multilateral agreement, really what is there in my slide is three pillars: the OECD pillar, the UN pillar, and the US pillar. And I mentioned that very often the debate on the UN and the OECD often gets, ignored. So, whereas the two-pillar discussion is always in the context of OECD, we tend to forget the importance of UN. So let me just give you 3-4 important features of what's happening at the UN level and what's happening at the US level. One, at the at the UN level, the African Tax Administration is all coming together. They have put out detailed proposals in November 2022, putting it out as their wish list for the two-pillar solution. There is a resolution that was adopted by the UN in its General Assembly in December 2022. This is going to lend a fresh. A new grouping of G24 has come up. They have started giving separate inputs, and their focus has been insofar as need for transparency is concerned, the bottom-up participation, focus on needs of what they call it as the global south, and looking at progressive and redistributive tax policies. So this is now a modification of what the G20 agenda is. On the other hand, the US, which drove the global minimum tax agenda as soon as the
वो आपका प्रोजेक्ट के थ्रू हो सकता है, लेकिन कोई ना कोई किसी न किसी तरीके से आपको वैल्यूएशन कंपनी का
Can I request everybody to be on the mute, please?
Yeah. The US, which drove the minimum tax agenda as soon as the Biden administration came into power, has many more things to offer. For example, the House Ways and Means Committee is now being consulted for discussions by the US Treasury insofar as the position that US should hold out at the OECD level. We all know US is pushing very strongly for Pillar 2, and the Pillar 2 should take precedence over Pillar 1. When Pillar 1 was being put into implementation alongside Pillar 2, most of the market economies that assumed the new taxation rights felt that this was a very important moral victory for them, but it seems that Pillar 2 will take precedence over Pillar 1 because that's largely aligned to the US domestic policy. With UN and India, some important developments are occurring. Now we will see that the India's Joint Secretary Foreign Tax and Tax Research also putting out written comments, which are also in the social media. So some of the highlights that the Joint Secretary FT and TR put out insofar as aligning itself, or India aligning itself with the OECD debate is concerned, are important statements like the two pillars travel in the right direction but do not travel enough. Now, there is something that you need to read between the lines when you look at this quote, largely because this is India's way of saying that Pillar 1 should have taken precedence over Pillar 2. When Pillar 1 came, we as a market jurisdiction assumed the taxation rights. Why should we move ahead now with Pillar 2? He also says that the developing countries have virtually no say in setting the agenda. Now, this is a very bold statement. Actually, a statement of this nature has not come out in the past. The debate at a multilateral level has been largely laced with words of diplomacy. I think this is a fairly significant departure from the words of diplomacy when there is a categorical statement being made that developing countries have virtually no say in the agenda. And when I talk about the agenda, I mean the two-pillar agenda. It also says that developing countries did not have an adequate role to play in the finalization of BEPS Action 1 and BEPS 2.0. 2.0 being the current.
Okay, 5 more minutes.
Thank you very much. Being the current debate. And then the inclusivity of the inclusive framework is much less than what is desired. India's comments to the UN and the UN resolution that was adopted in December 30th, 2022 is an important step. India has recommended 7 work streams to the UN. It needs to be seen in the next UN meeting in October how many of these work streams make progress, because this is just India's view. Number one, the nexus rules should look beyond the physical presence, which means reviewing Article 5 and Article 7, which means India will bring forth its agenda that it doesn't necessarily agree with the OECD's authorized approach. Revised rules to tax income from services could see modification of fees for technical services, somewhat of a modification for Article 12A. Reviewing the existing rules to tax income of remote and mobile workers. This is not just an agenda that India has put forth, but there's been a fair bit of debate in many parts of Europe as well. Developing rules to look at taxability of stateless income. We have seen changes in the domestic law in the last couple of years, which tend to signal India's desire. And then there are some other general items on the agenda, which includes taxation of offshore direct indirect transfers and standardization of the arm's length principle and developments of benchmarks. The US response to UN has been fairly interesting. The US response essentially talks about UN being an all members inclusive framework. US supporting the OECD by saying that it's an all members inclusive framework and everyone is participating on equal footing. And it also says that every member has a real voice in the negotiation, and that is questioning whether a UN process will actually make sense, arguing that the UN process historically has not been able to deliver. India's policy stance on OECD is interesting. There's been a fair bit of debate. I won't get into that because I saw Bala's name also from Ministry of Finance. He would possibly cover that. The last aspect that I want to cover was in the EU anti-tax avoidance. This is going to be, kind of kicking off on July 1, 2016. What really this means is that interest limitation rules will kick in, exit taxations will come in, general anti-abuse rules will apply. Besides domestic rules, the EU-led rules will apply, CFC rules will apply, and anti-hybrid mismatch rules will apply. All of this means that and the EU ATAD agenda is really at the three levels: July 2016, which is the list that I spoke about, May 2017, and December 2021, when the Unshell directive will come in. So you are really seeing a surge in the quantum of changes that are occurring at the EU level, which is going to impact the structures of not just EU headquartered multinationals, but also US headquartered multinationals, which are structured internationally through the EU. So let me stop over here, given the time limitations, and I'm going to send the slides. I can see the slides moving on my laptop, but I apologize that it couldn't move on the presentation format. Thank you.
Thanks, Mukesh. Yeah. I think Tapti, I think I will take it forward from here.
Yes, please, Girish, go ahead.
Okay, fine. I think quickly, Mukesh has given an overview. Just to give you again, reiterate, the BEPS 2 project had two elements: Pillar 1, a new nexus and profit allocation, with the object of greatest share of taxing rights over global business to market economies. And you have heard from Mukesh that it seems Pillar 1 is not getting its due attention, and thanks to US. So US is more interested in pushing Pillar 2. And then Pillar 2, primarily the fundamental changes is the global minimum tax for corporates, which is contemplated. So let me just take you through, before I get into the panel discussion, take you through some developments which has happened in the in international tax. Primarily in July, we had in Ireland a feedback statement released on transposition of minimum tax directive launched on, especially with respect to Pillar 2 of BEPS 2.0. That is on that. G20 just reiterated its commitment to Pillar 2, but nothing specific had come out of G20's meetings. I think that's the sum and substance of it. If you look at the Denmark, there is a draft proposal to transpose Pillar 2 into domestic law. That's a development as far as Denmark is concerned. Germany has put out a draft bill to implement global minimum tax into German national law. It has been published for debate. On the treaty, then you have an interesting Netherlands-Belgium treaty, which has come out with a specific representation and explicit reference that TT provisions do not prevent application of Pillar 2 legislation. That's quite interesting and will be worth debating whether EU member states will take the same position. I think that's for debate. As far as Mexico is concerned, they had published an enactment of the MLI. That's a development. On the treaty, US Senate has approved for ratification of the US-Chile income tax treaty. That's the development as well. International stuff is concerned. Let me quickly throw open for panel discussions. Let me go into first on Pillar 1. And okay, sorry, I just forgot to mention this. There's a major development from the OECD, which was on the 17th of July, they introduced the certain proposals on the subject to tax rules, which is STTR, and we will debate on that. On the Pillar 1, the new nexus, what has happened is with the Multilateral Convention, MLI, on Amount A of Pillar 1 with respect to defined portion of the residual profits. There has been a kind of proposal which has been put forward by the OECD. That's on 11th of July. The question really is whether this will help developing countries or it will not have any impact. That's worth debating, especially when you're dealing with market economies. The second major issue which we will debate in the panel really would be the subjective tax rules on Pillar 2, how this is going to really impact developing countries. And the third is the kind of specific reference in the treaty provisions which has been made in the Netherlands-Belgium treaty, how it's going to impact the EU member states. Let me start with one. I'm going to call upon Amit Gupta to say what is his view, especially on the Pillar 1, the new nexus with the Multilateral Convention on Amount A of Pillar 1 with respect to defined portion of the residual profits. Does it help, especially the debate which developing countries have? Over to you, Amit.
Thanks, thanks, Girish. So, if I have to say, does it help? Yes, it should. It should, but will it ultimately mean in terms of extra revenue for the developing countries? Will have to be seen, because what gets covered, the revenue sourcing rules and how the allocation really happens, the residual profit, because amount A, how much is really in the basket of amount A is what will need to be looked at, correct? After taking into account amount B. So, so it's all about the calculations really. Theoretically, yes, that's the whole idea, correct? And the purpose of it helping countries where the market jurisdictions really is the whole purpose of it. But I think a lot of it would boil down. I think we all say it, and it would be on the implementation, how really the numbers play. What players, what are the number of players or the big multinational corporations which will really come within the purview, given the thresholds and all of it. So there are many factors we need to look at. But obviously the idea is here for it to help. Will it ultimately? We'll have to wait and see.
So Amit, would you say, I think the OECD at least has brought some clarity, or is it still hazy? Because in my view, from what I hear, Pillar 1, in the absence of clear allocation rules, is still hazy. No one is clear that what really would be the additional revenue which a developing country will get, and which the developed economies sacrifice their tax base.
Yeah, so that is why I said theoretically, correct? Because ultimately it all boils down to the clarity, the numbers, who gets covered. I totally agree. Who is willing to give up how much? Because merely bringing a taxing right within your domestic law by itself may not be enough, correct? Because I think it clearly says amend your law, do what you have to do, but the other side has to agree. It should not end up being a double taxation and all of it, and that's where the MLIs and all of it will come into play. So I agree with you, Girish. There is more clarity required, and as was mentioned earlier, it seems now the focus is more and more on Pillar 2. Get that implemented quickly, and I think we will talk about Pillar 2 also, correct? So I will not speak much on that now. But I agree. But I agree with you. We'll have to wait and see. There is more to be done. So there is more that needs to be done.
So I think there's a separate discussion, I understand, on Pillar 1 later, but I would just restrict myself to this particular new development which has happened in the multilateral convention on the OECD 11th of July. Let me go into the STTR, which came out on the 17th of July by the OECD. So I'm going to request Hitesh to say how will this impact developing countries? Because my personal view is developing countries, the whole tax base is based on a completely different system, because developed economies have a large personal tax base, whereas developing economies, their large dependence on the tax base is still corporate taxation. So the question really would be, like, how does this SCTR really help? Does it really help, or is it another statement by OECD? What do you, Hitesh?
Thank you, Girish. May I request that the slide presentation be removed, because then we can see each other more clearly. This is a disproportionate large amount of my laptop, at least, is being taken up by this cover slide.
Okay.
So
okay, I think I'll ask Mukesh to Tapti or Mukesh to remove the slide presentation.
Okay, so let's look at what is the STTR, or the subject to tax rule, really. It allows source jurisdictions to tax back where defined categories of intra-group covered incomes are subject to a nominal corporate tax rate below the STTR rate, which has now been agreed at 9%. And where domestic taxing rights over that income have been ceded under a treaty to the resident country. So STTR specified rate being equal to the difference between 9% and the nominal rate applied in the resident state, and further reduced by source taxation already allocated to the source jurisdiction in accordance with the articles of the treaty. Say, for example, if a payer jurisdiction, that is India, that is a multinational branch, a branch of a multinational company in India, pays, any of the covered incomes, and by covered incomes is meant interest, royalties, payments for distribution rights, insurance premiums, reinsurance premiums, payment for guarantee, financing fee, rentals for ICS, that is industrial, commercial, or scientific equipment, and payments for services. So if, for example, India is already, let's say, levying a 5% withholding tax on such in-scope payments, and let's say even if the recipient is subject to only a 3% nominal tax rate, then India jurisdiction, that is the payer's jurisdiction, can impose an additional tax under STTR only now equal to 1%. STTR specified rate of 9%, less already the withholding tax rate of 5% minus the nominal rate of 3% is equal to 1%. And also another factor is that for services, what is excluded is the costs of rendering such services plus a markup of about 8.5%, which India had protested as being rather high in the context of services which were to be paid out to developed jurisdiction. Also remember, this is to be paid out only to connected persons, and there are also certain exclusions like payments to individuals, foreign states, central banks, investment funds, pension funds, not-profit, etc. Therefore, to my mind, Pillar 2 again would apply only if the sum total of the intra-group covered income which are paid to a foreign jurisdiction in any fiscal year exceeds 1 million euros or about 90 million Indian rupees. And where the GDP of the payee jurisdiction is less than 40 billion, then a reduced threshold of 250,000 euros would apply. So to my mind, India has already recorded its specific reservation, but perhaps is realizing that both under Pillar 1 and Pillar 2, while the direction to bring some more tax revenues to developing nations is in principle being respected, but it is not being carried through in actual terms so far as the real dollars that will actually flow back to India under the made up tax after the end of the fiscal year to cover up the shortfall.
Thanks, Hitesh. The other one which I would want either Hitesh yourself or Amit to just take over. The new amendment.
KRG, just a small interjection. Sorry, I wanted to highlight on the first point itself, even on Pillar 1, where is the real grievance? And if I may explain with an example for the benefit of everybody, if you permit me, I'll do that.
Please go ahead, because I think the situation really is this good enough what OECD has put forward as part of the multilateral convention of on amount A of Pillar 1 with respect to defined portion of the residual profit. The question really is, does it really help?
Exactly.
If it helps, it's good.
So what I did, what I tried to do is I tried to make a numerical example, because Pillar 1 is also hedged in with lot of let's say numerical guardrails. So first of all, it shall apply only to very large multinational enterprises where the consolidated group turnover has to exceed 20 billion euros, number one, and cumulatively the profitability of that M&E also has to exceed 10%. Now, so first of all, these are the thresholds, and the Pillar 1 applicability shall be implemented by way of amount A if both the above two thresholds are cumulatively met. Then Pillar 1 states only 25% of residual profits at group level can be allocated to all the market jurisdictions. So take, for example, I have a very large M&E whose total revenue is, say, 100 billion euros, and its profitability is, say, 30% profit before tax. So it is 30 billion euros. Now, obviously, both conditions are cumulatively satisfied, more than 20 billion turnover and more than 10% profit. But if you see, the excess profitability over 10% is actually 20%, which is 30 minus the 10%, let's say, guardrail. You are left with excess profitability of 20 billion euros. And of that excess profitability, the reallocation percentage is again only 1/4 or 25% of that. So what is left behind for reallocation in a 100 billion euro turnover is only 5 billion, which is again to be spread over all the market jurisdictions. So truly digital economy, which is operating in, say, 40 jurisdictions or 50 jurisdictions all over the world, including India, if those calculations are done, I really don't know how much of that profitability, because overall, please understand, of 100 billion euro turnover and a 30 billion pre-tax, only 5 billion is being actually reallocated all over the world in all the market jurisdictions. And therefore, one can sense the discomfort of India's competent authority when, those statements were made that, while the direction is right, we are not traveling far enough. So I just thought I would add that so that, the discussion on both Pillar 1 and Pillar 2 gets a sort of a rounded completion.
Thanks, Hitesh. I think that was good to understand the real. This, in theory, as Amit said, it might sound good, But if you really put in practical terms, this is really nothing in terms of market jurisdictions. What is that? These residual profits is going to those developing economies. The third one I would want to just ask, I think both you as well as Amit, I think I find anyone can answer this. The change which has been brought in the Netherlands-Belgium tax treaty with explicit reference that treaty provisions do not prevent application of Pillar 2 legislation. How do you see that in the EU context?
Amit, would you like to go ahead?
Yeah, I can start, and maybe you can add. So yeah, so this is quite interesting, where a treaty clearly specifies that anything that happens from a Pillar 2 perspective would have precedence, correct? So that's very interesting, and I think I don't know what will happen, or what will other countries do in terms of their tax treaties, or how it will play in terms of the MLIs and the other stuff. But this clearly says that Pillar 2 is being accorded precedence, correct? And that seems to be the idea, that clearly have a minimum tax in terms of countries which are really sort of, they rely a lot upon tax incentives, correct, to attract foreign investments. And with Pillar 2, it would be quite interesting to see how these countries react and how they play out in terms of their domestic laws, or the incentives that are being given currently, and in terms of tax treaties. Hitesh, you want to add on?
Yeah, sure.
Hitesh,
So,
you want to add on?
yes, KRG. Thank you, Amit. I think that sets the context. Now, as I was reflecting upon your question, KRG, what struck me is that imagine the plight of a taxpayer who now has to look at not only domestic law of, let's say, both the countries. Also, mind you, he has entered a particular jurisdiction with an explicit promise of, let's say, a favorable tax treatment for at least the next number of years, which I don't know now whether that can be challenged on the ground of promissory estoppel. So that is number one. Number two, the treaty itself is being amended now to give due credence to what is being said in Pillar 2. And an interesting question arises is that most European treaties have this most favored nation clause applicable to other states, in the European Union. So if, let's say, Belgium and Netherlands amend their treaty, and let's say either country has most favored nation clauses which say that, we'll give you a more favorable treatment, whether can any country object to say this MFM is not applicable to me because actually it's not more favorable to my residents. So that will raise another interesting, battleground so far as the poor taxpayer is concerned. And typically, the commentary around, let's say, the Pillar 2, which has been released, if you read the fine print, it nowhere states that, treaty provisions cannot prevent the application of Pillar 2 globe rules. So frankly, two EU member states, as a matter of conscious policy decision, have chosen to amend their treaty, giving precedence now to something which is actually going to be decided by the entire inclusive framework, if you will. Therefore, in a sense, their own sovereignty they are giving over to perhaps what may be now enacted as another MLI to give effect to the STTR rules. So I think we are in for a lot of interesting discussions over the years ahead as to what happens with the interplay of domestic law, individual treaties, most favored nation clauses, and the new MLI which is being proposed.
And Hitesh, do you believe that MAP has any play here at all in these situations?
Actually, quite the contrary, because now, you have no grievance, right? It's both competent authorities who have negotiated the treaty, who have agreed upfront that we are going to give precedence to whatever the globe rules are enacted or Pillar 2 rules are enacted. So I don't see any scope even now for going for an MAP. That's why I said the poor taxpayer will now be in heightened uncertainty. Perhaps, I think already much of Europe is frozen so far as tax planning is concerned, with the disclosures that advisors and corporates have to make for aggressive tax positions, etc. And this adds just one more scope. And it's interesting again because see, both are in a sense developed countries. Both really, even if they give effect to low pillar 2, I really don't know whether incremental revenues will result as a result of this change made in the treaty. Actually, it perhaps just puts taxpayers much more on the defensive, and they will have to be vigilant to see that they unwittingly don't get caught into any discussion between the two authorities, who now both will claim that per the new pillar 2, much more tax is due from you in my country, because both will say, look, this is how we are applying. Ultimately, the proof of the pudding also is in finding an agreement to how these rules will play out, right? Which again in December are going to be spelled out as to exactly how STTR rules are going to play. So a lot will depend again on how that is enacted.
Thank you,
Girish, on the MAP point, I just want to add, except I agree with whatever Hitesh mentioned on the MAP point, except for the fact that a taxpayer may want certainty on the aspect of double taxation. To that extent, get a certainty, I think MAP may still be beneficial until and unless, because the rules are so clear that there's no element of doubt left in terms of any element of double taxation, how the calculations are done, who wants to take how much share is all very clearly and well defined. Until and unless that happens, I think MAP may still have a role to play.
Amit, sorry, I think most jurisdictions, tax treaties do not allow advance MAP. Maybe they will need to seek something else.
Correct.
Because MAP will only arise after a dispute is registered, right?
That's right, Hitesh. That's right, Hitesh. You are right. There is no advance MAP.
Correct. So they will have to enable mechanisms. So for certainty, they will have to enable new mechanisms, I think.
So that was my point, Hitesh, that if as a taxpayer I disagree, I'm able to show that I'm ending up paying twice on certain elements or how the calculations are happening. That is where I am at. I have a grievance or a dispute or whatever, and I use the MAP to go and get a resolution for that. Was my point.
Yeah, but Amit, your life becomes miserable because it's going to now take years to resolve something, whereas you would have ideally liked in advance a certainty to plan ahead.
Correct. Or then maybe a bilateral APA in advance.
Yeah, given this situation, there has been a talk now largely with the tax experts over the globe that it's high time we get out of this OECD and go to a world tax organization. What's your thoughts from both of you?
Actually, I personally believe that this is a very lofty sounding idea. But if, getting so many countries together and even trying to, drive some sort of a consensus on what actually originally started only as a digital taxation. I think somewhere down the line, the whole plot went completely awry and digital taxation was almost forgotten until again Pillar 2. So while this is a lofty ideal, I think achieving it will be a challenge is my.
Okay, got you. I think given the positive time, I'm not going to get into more discussions. If there is anything else both of you would want to bring it, more than happy to debate and discuss. But otherwise, we will conclude this panel discussion and hand it over back to Tapti.
So just one point, just one point. When we think of these changes, Pillar 1, Pillar 2, we sort of focus only on the large MNEs as are having their headquarters in overseas jurisdictions. But if you look at actually things like STTR, etc., the thresholds are not that large. If you ask me honestly, there ought to be, and rule of thumb, we did some calculations in our firm, there ought to be at least 100 plus Indian corporates alone, which will have to gear up for the STTR regime. So I think we should use this platform to give out the message that this is not some tax coming in the distance. This actually come home to roost today. And unless you start preparing, start looking at flows, frankly, you are filing a CBCR. Now under Globe rules, we'll have to file a GIR or Globe Information Report mandatorily with the tax office. How do you prepare and gear up for that unless you start thinking about STTR, etc.? So I think the time of the hour is for Indian corporates actually to, wake up to this new reality. I thought I would use this platform.
That's a valid point. That's a valid point, Hitesh, because I don't think the Indian corporates have not even bothered to even look at this, because this came just in 17th of July, as recent as that. And I don't think anybody, and even frankly, if you ask me, I didn't see even much articles also on the net on this particular issue. It's quite so when you are saying around 100 plus Indian companies will be affected, I think it's better they wake up.
Right. Thank you.
Thank you. Tapti, do you want to take back? Or
you're on mute.
You're on mute. You're on mute.
Sorry. Thanks, Girish. Wonderful panel. Thank you all. I'll just hand it over to Sunil to do the honors in introducing.
No, I think I would thank my panel, both Amit and Hitesh, who really articulated pretty well, I think, on a subject which is difficult, I think, actually.
No, and Amit, remarkable commitment. You just flew in today from Bangalore to Singapore, and I know how a Friday evening or Saturday evening in Singapore is for you to be locked up in your hotel room and attempting this.
No, I'm not in my hotel. I now live in Singapore, so I'm at my home only.
All right.
No, the trouble was I took the red eye. That is why I was saying, okay. So.
Okay, all right.
Yeah.
Anyway, thanks both of you.
In Singapore now.
Both Amit and Hitesh, I think it was wonderful listening to you. I think when Sekar gave me this opportunity, I immediately told Sekar, yes, Sekar, I am ready to, because I will learn in all this stuff from professionals who are in thick of this practice.
No, and thanks to you, Girish, and thanks to Mukesh also for setting the opening context. Thank you.
Thank you very much.
Thank you.
Over to Sunil.
Sunil Fabala.
Thank you, Tapti. Good evening, everyone. Again, good evening, Bala. I hope I'm audible.
I can hear you.
It's my real privilege, to introduce K. Balasubramanian. He needs no introduction to all of us, especially in BCIC and to everyone in the tax fraternity, but I will, still do the introduction formally.
Before you do that, Sunil, I think I'll be thrown out of the government if you don't change the slide. I'm not secretary. I'm just a joint secretary.
Apologies on that oversight.
No, that's fine.
So introducing K. Balasubramanian, Joint Secretary, Government of India, Department of Revenue. He's responsible for the tax policy analysis and research. Balasubramanian has over 25 years of rich tax experience, direct, indirect, and international, having previously being the head of a global tax of a large Indian conglomerate. I'd like to thank Balasubramanian for kindly agreeing to address us this evening, which is a Saturday evening. Thank you for sparing your time on the topic of role of India in global tax emerging scenario. With that, I will hand it over to Bala.
Thank you, Sunil. And I had the opportunity of listening to KRG and also Mukesh, Hitesh, and Amit. Much of what I wanted to cover in terms of the international developments, I think they have covered. So I'll not go into the specifics of the developments, but I would like to place my perspective on what I see from this side of the aisle as to what these developments mean for the country and what India is doing for voicing the concerns of itself and also of the global south, because we have a very important role to play in the global arena, especially that we are having the G20 presidency, but also as a responsible country in the global arena, we are also voicing the concerns in the right perspective. And before I do that, I think it is also important to put a perspective as to where India stands today, right? Economically, fiscally, and also politically, it is very important to understand why India's voice is being heard the way it is heard today. If you look at the post-COVID situation, I think Mukesh also alluded to this in his opening remarks, that the recovery has been very choppy, right, world over, and the fiscal measures that were taken globally, in India took a little bit of a different stance there. Uh, Possibly it has paid off very well in terms of the recovery that we have seen, in terms of the credit growth, in terms of the profit of the domestic companies, in terms of the GST collections, also signaling a yes, very strong consumption revival. If we look at GST collections alone, over a period of 5-6 years that GST has been in place, last 1 year has been very momentous in terms of the revenue collection, and consistently we have crossed 1,60,000 crores, 1,50,000 to 1,60,000 crores, and that's not a very easy achievement given the kind of tax base that we have from the GST. Although we have tried to expand the number of taxpayers, almost double pre-GST era to what we have today. But the digital implementation of the entire GST system has helped us get to a position where we are today. When you look at the I think Girish alluded to this very subtly. What I would be very concerned, of course, this is my personal view. So, and all of these are my personal views. So none of them reflects the government's view here. So what should concern the country is the composition of the tax, right? The quality of the tax base and the composition of the tax itself. So first is the composition. So when we look at the overall composition, direct to indirect, I think India is very skewed in terms of the overall taxes. So I would like to include the state taxes also in this. So if we consider the overall state tax and the central taxes as a whole, it's about 45 lakh crores, right? Out of that, for this current fiscal year, what we would get as direct taxes is about 18 lakh crores, right? So this is not a very healthy mix, because the direct taxes are not very progressive in nature. Direct taxes are very progressive in nature, but the indirect taxes are very regressive. So indirect taxes constituting the major chunk of the overall taxes in a country like India, where we have the inequalities very wide and disparate, that is not a very good sign. So that is first in terms of the composition. While if you look at indirect taxes alone, it's about 11-12% of the GDP, and 11-12% of the GDP and an effective rate of GST and indirect taxes being about 13-14, maybe it is 15 this year with all the changes that we are looking at, etc. May not be a very bad average as far as the OECD is concerned, but there is a pressure which is there because of certain artificial disallowances and deductions that we have denied to the businesses on the GST side. So I'll not dwell into much on that, because this is more an international tax topic, but that is a cause of concern as far as the government's the composition of revenue is concerned. Now, when you look at even within the direct taxes, now what does the global average say? The global average says that, if you look at US corporate taxes constitutes only 6%, right, of the overall taxes, including the consumption taxes, including the social security taxes, etc. The personal taxes plus social security constitutes about 75%. Now, this is what Girish alluded to. I'm just putting numbers. I'm very happy he highlighted this, because this is important for us to understand why international tax is more important for the developed countries and not so important now for the developing countries. At the same time, how do we protect our interests? So that is the the scheme of things that I'm trying to take this discussion through. Now, when you look at the US taxes, I said 6% comes from corporate tax, and how much of it will come from international tax, right? 70% of the US corporate tax would come from international tax, right? So this is a very, very interesting, statistics that we will have to look at. Now, when you look at the OECD average, the OECD average may not be 6%, but I think it's about 10%. 9 to 10% is the corporate tax composition, because the social security may be a different component. The consumption taxes are little less as far as the European countries are concerned. So the averages become little bit of a different figure when you look at a very global level. But the individual taxes, including the social security component, is about 53%, right? 50 to 55%. So there is a very heavy reliance as far as their tax revenues are concerned from the individual taxes. So what they get from all of this pillar one, pillar two, all these issues are on top of all of these, right? So they are basically, their tax kitty is protected, right? When they come to any negotiating table, because they have a very heavy reliance on individual taxes, they are not too bothered about the international tax affecting their own tax revenues, right? But when we look at India, what does India say? What does India's number show us? 18 lakh crores is the direct taxes. Out of that, 50-50 is the the bifurcation between individual taxes and corporate taxes. So 9 lakh crores or 9,25,000 crores is going to come from corporate taxes this year. Hopefully, the first quarter trends don't show that, but we are still hoping that the corporate profits would pick up during the year and we would hit the budget estimates. The individual taxes also is about 9 lakh crores, right? So we are catching up. In fact, when we looked at this number 2-3 years back, probably it was slightly different, and that is the whole reason why the corporate tax rates were brought down significantly in 2019, and very, very appreciative of the corporates. The compliance has picked up in such a manner that the corporate tax reductions have not had a significant effect on the tax revenues as far as corporate tax is concerned, because we had a very steep reduction, a 20-21% reduction in rate. But when you look at the corporate tax as a percentage of GDP, right, what it was as 3.2% in 2018-19 has come down to only 3.06% last year. So a very steep reduction of say 20-25% has resulted in about 5 to 6% reduction in a relative term when we measure it against the GDP. So therefore, to that extent, the compliance, the reporting, and the collection efficiency has matched as far as the rate reduction is concerned. But having, I think, be that as it may, but when we look at this composition, what it tells us is we are today heavily reliant on corporate tax, and therefore any changes that affects our business, any change that affects our multinationals, Indian multinationals which are operating outside India, and any change in the tax landscape for the foreign companies which are operating in India is a very important and a deep concern as far as the Indian government is concerned. Now, when we looked at 2016, and did the equalization levy provisions, right? We thought, probably the revenues would pick up, and most of these digital companies would start coming within the tax net, and the revenues would be about 20-25,000 crores. But what we saw in equalization levy has yielded about 3 to 4,000 crores at best, right? I may not tell you the exact numbers because I don't think those numbers are in public domain, but take it, give it, plus or minus 1,000 crores. It has not even crossed 5,000 crores. So what we saw in equalization levy is not giving us comfort as far as pillar one proposals as they stand today, right? Because what it means, pillar one, I think all the speakers alluded to, it is about giving up tax rights that we have already assumed in terms of these digital services tax, which is in India called the equalization levy. But what we are getting in return is 20 billion plus 10% profit companies to report something which is an amount A, which is what I would say is a very minuscule component of the overall the corporate profits, right? And when you look at that, the number of companies which would go out of the country, right, in terms of the tax reporting in India is much more, will be much more than what would get reported to India, right? Because what will happen, there are a lot of exceptions in amount. I wouldn't like to go into specific details, but even those companies, even assuming a consumer company is there in the country and that is part of a global conglomerate, and that is doing domestic business in India, they are manufacturing in India, they are selling in India, they have products and brands in India, but just because they are part of a global conglomerate, right, or a global MNC about $20 billion, and they are reporting more than 10% profits in India, because in India the margins tend to be a little high, right? We have seen that in many companies. Amazons of the world do not report more than 10%. So if you ask me whether Amazon will come under pillar one and report more profits in India, I don't think so, because they are not about 10%, right? Yeah, in terms of their profitability. But what would happen is some of our Indian companies, despite having domestic business, domestic market, would have to cede some of the profits to be taxed in the foreign jurisdiction. So therefore, that is the concern that India has put forth, saying that this does not reflect. I'm just putting it in very simple terms, while the concerns are very technical and what we have put forth. And I think there was also a slide which Mukesh had shown on what my counterpart in FT and TR had written. But I'm just trying to put it in very simple terms, that what we would get from pillar one may not be sufficient for us to cede what we have taken or assumed as a taxing right under the equalization levy. But if you ask me whether the equalization levy is the right levy, probably not. So what then it would take us to in terms of pillar one is what we are trying to negotiate on behalf of us, and also on behalf of the global south. Probably there is some kind of a discussion which is coming to fruition. So we will see how pillar one is going to take shape, but still lot of concerns in terms of the complexity, in terms of how the dispute resolution would happen, in terms of I think there was a very interesting discussion on advanced map, whether the map would go away. I think those are the concerns that taxpayers like you, the industry associations like you, have to come up, right? So I don't think we are seeing enough of that. The government is having its own views, and it is raising those concerns. But I would encourage the industry associations like you, partners like you, raise those concerns, and work with the government and strengthen the government's views on this so that the right position is taken on pillar 1. But what is more concerning is the urgency with which pillar 2 is being implemented globally, right? And whether India would come up with pillar 2, probably it has to come up because we can't be left behind, because if we don't enact our laws, we would lose the right to get those residual profits, right? So therefore, probably India cannot be left behind. But then our stated position has been that pillar 1 and pillar 2 should go together. It should not be a case where pillar 2 precedes pillar 1, and countries race to do what they are doing as far as pillar 2 is concerned. Whether pillar 2 is a good position, yes, it is a good position, because whether there should be a minimum tax, yes, there should be a minimum tax. Whether the resident country should have the right to tax when the minimum tax in the source country is less than an X percentage. I think those are very good, principles to have, in the world that we are living in. But there should be a meaningful, negotiation on the table, which reflects the developing countries' requirements as far as these profit allocations are concerned. Now, this is what is as far as the multilateral negotiations are concerned, and how pillar 1 and pillar 2 are going forward. But there is another interesting development also that we all must be conversant with, in terms of the exchange of information, right? And the country by country reporting, and also the CRS, the common reporting standards, which have been implemented and which are taking a lot more good shape in the country today. So you would see lot more of automatic exchange of information, some of your transfer pricing assessments being subject to those proceedings, where your transfer pricing auditor will refer the matter to the other country, to the other contracting country, for the purpose of seeking information. So therefore, what I would suggest, to this forum, I think I didn't see a specific agenda on these exchange of information. Probably you must discuss some of the developments and some of the pain points that the industry may have on these matters, because it may disrupt your transfer pricing proceedings, it may disrupt your APA, it may disrupt your map, depending upon whichever route that you have chosen. So what are those practical difficulties that the industry faces in terms of these proceedings, the CRS, the FATCA, the exchange of information? I think the industry must deliberate more on that aspect as well, and come up with meaningful suggestions and meaningful implementation measures that the government should look at, because I don't think the objective of the government is to put any burden of compliance on these aspects, but it is just to have complete information about what the assessee's profile has been in the world, in their global transfer pricing arena. So I think it is very important that this aspect should also be looked at, along with other aspects like pillar 1. Pillar 2 are futuristic, and as Hitesh pointed out, pillar 2 would at best affect, my assessment, in my independent assessment, is about 150 companies. He said 100 plus. I think it would be 150 companies. Pillar 1, while not too many would be covered by the 20 billion threshold as far as the Indian MNCs are concerned, but at least 25-30 of them, which are part of the global MNC group, may be affected and may be required to keep those documentation and adjust their gap in terms of what is provided for. So therefore, we are looking at about 200 companies being affected at this point in time. So in other 2 years, probably it may look like 200-250 companies, but it's a very decent size. And my guess is that most of these companies may be in Bangalore. So therefore, the Bangalore Chamber should take lead on these aspects, come up with meaningful deliberations as you are doing, and voice the concerns to the government, and also give suggestions on how these should be meaningfully implemented. So I think thanks for inviting me here. It's wonderful to be back in my own the old Bangalore chamber in terms of addressing you all, but with a different perspective that I've been able to gather in the last 18 months from the government. Thanks to all of you, and good to see that these programs are being conducted the way they are conducted. Thank you.
Thank you. Thank you, Bala, very much. Very, very, I think, insightful, but at the same time, getting us the data around, how the tax composition is in the developed countries versus India, and why, that is the main reason why, we should be concerned on possibly the flight of tax collections that might happen outside. I think that was helpful. And I do agree that while not too many companies are possibly affected at this point in time, I think more engagement from industry would be helpful, because once the rules are framed, then there's not much that can be done. And the way the Indian companies are now growing, both within India and globally, it's only a matter of time when these thresholds will come down, and there'll be more and more Indian companies who will be getting caught under the Pillar 1. And on your point on information exchange and all of that documentation that we need to have, certainly that's a thing that we will take it up from the chamber's point of view, get all of our members their inputs, and present and our concerns on what we can do with the government. Thank you, Bala, very much for taking time out. Really appreciate your spending time with us on a Saturday evening. Thank you.
Thanks, Bala. I think what you brought out was extremely clear, because very interestingly, we have now an Oxfam report which clearly says it is the poor who may pay more tax in India, which could be a little bit skewed. It'll be a little bit skewed because of the GST.
No, I have my own views on that, Girish. So
okay,
I wouldn't subscribe to the Oxfam's view, but
yeah. No, I also don't subscribe. I agree with you, Bala. What happens is Oxfam's report gets very much publicized because I think I got so much of.
It gives us lot. It gives me a lot more work also.
yeah.
But we will have that debate another day on why Oxfam's report is not correct.
Very interesting. Your talk was very interesting. Thank you very much for that.
Thank you, Girish.
Thank you.
Thank you, Bala.
Okay, let me just hand over now to Shriram to take over for the next session. Over to you, Shriram.
Yeah, thanks, Sunil. It's my pleasure to moderate the next session, which is on Pillar and Pillar 2, and the implications of Pillar and Pillar 2, especially to India and to more specifically the Indian taxpayers, the way I would look at it. I think that the initial two sessions we had for Mr. Girish and Mr. Girish and Bala has given a right, background for us to straight away get into this session on what is Pillar and Pillar 2 and how is it expected to impact India. Right now, I have with me in my company two great tax professionals who have had, close to or more than 2 decades of experience dealing with tax matters and dealing with international tax matters, and it's my pleasure to introduce them. We have with us Ms. Shikha Gupta, Head of Tax of Hindustan Unilever, a professional with more than, I would say, close to 25 years of experience in the field of tax. And before joining HUL, she was with Novartis, GE Capital, as you could see, all M&Es. And that's why probably the right person to talk about the implication of Pillar and Pillar 2, because it's going to impact M&Es. And we also have with us Ms. Nithya Srinivas. Nithya heads the taxation for Wipro GE Healthcare. And again, professional with close to 2 decades of experience with both with the corporate as a taxpayer, but and also as a consultant with the consultancy firm before she forayed into the taxpayer side. So it's a pleasure, Shikha and Nitya, to have you with me in this discussion on Pillar 1 and Pillar 2. So I'll just probably take a couple of minutes to just give a perspective of where we are in Pillar 1 and Pillar 2, and then we will have questions for Nitya and Shikha to give their views. Now, as you would know, Pillar 2 has progressed a lot faster than Pillar 1, and Pillar 2 is the global minimum tax is now being signed by more than 130 odd countries, and while the globe rules have been published and have been in the public domain for quite some time now. And what is also interesting is that while the globe rules have been notified, the implication or the implementation of the globe rules and Pillar 2 and collection of global minimum tax has to happen through domestic regulations. And it will be interesting to know from our panelists as to what they see on what's happening on countries doing to implement Pillar 2 rules. With that, and Pillar 1 we'll get into later, because Pillar 1 will evoke, I'm sure, a lot more emotions, a lot more questions, and a lot more controversies than what Pillar 2 can. And some of it were covered by Girish in his presentation, in his panel, and also by Mr. Balasubramanian, when he gave a perspective, India's perspective as to how the current rules, Pillar 1, the way they are, may impact the developing economies. So with that background, my first question is to Nitya. Nitya, we have seen some reports of US writing to the OECD that US may not support the deal the way it is today, depending on how the bipartisan is, behaving in the US. So, what is your perspective on where is US on this deal specifically? Because the question becomes all the more important, because the Pillar 2 agenda on global minimum tax was actually driven by US, right? And that's where probably we believe the consensus has also been reached. Where is US now on the whole OECD action on Pillar 1 and Pillar 2? And if you can also throw some light on how the countries have gone about implementing these rules. Have you seen countries notifying domestic rules, and where do you think India is on this? Or because we were expecting some of the rules to come in the last budget, it did not come through. So where do you see India, going ahead with implementing Pillar 2 rules?
Sure, Shriram. I think maybe just going back to the fundamentals and the need for these modified tax proposals, Pillar 1 and Pillar 2. Bala said it perfectly. I think the basis is to ensure that the developing countries have a fair say in the rights of tax. These allocations were, if you see the erstwhile treaty system, more skewed in the favor of residence-based countries. A lot of taxes were accruing to the developed countries, including US and Europe. The G20 framework, of which India has been an enthusiastic partner, has been directed towards reallocating these taxing rights in a more equitable way, allowing, again, as Bala said, a more fair share to the developing countries and a more source-based rule applicability for these taxes. It is in this context has to be applied to the changing world of business, digital economy, and the way the business is happening today, and the kind of changes that we are seeing. Every day there is a new change thanks to the digital economy. Something that we as a generation did not even envisage maybe a few years ago is very real now. The US stands at the forefront of this digital revolution. So you see some of the biggest tech giants, Amazon, Apple, you have the entertainment giants coming up like Netflix. You have Amazon as another giant in its space. All of these companies have headquartered their operations across the world. And because a lot of their revenues are coming in from the digital space, which is something very much that the US is eyeing, the question then arises as to what are these proposals that can be made effective in such a way when the US itself is not a participant in these conversations. The US has made it very clear that they do not subscribe, or they do not yet subscribe to the notions of Pillar 1, Pillar 2. To your point, the political environment in US is a key reason why that is the case. But the fact remains that US needs to be brought on board, and I believe it will. It is a matter of time. But if you see the current administration's take on Pillar 1, Pillar 2, Pillar 1, while they are still hesitant, but Pillar 2, they have sort of looking at minimum tax rates and some steps which have been taken, for instance, be it or maybe US baby steps towards implementing Pillar 2 in some shape or form, as things go forward. So I do believe US will get there, maybe not there yet. But to answer your point, their involvement and their the need for them to be on board, given the US companies which today are leaders when it comes to the digital economy, is extremely high. That importance cannot be understated. That being said, where is the rest of the world? I'll just maybe just share some brief sort of around the world kind of stats in terms of where the rest of the world stands on Pillar 1, Pillar 2. Australia has amended its accounting standard to align it with Pillar 2 disclosures. This happened on the 27th of June. Bulgaria has intended to introduce a domestic top-up tax. Denmark and Germany have revised draft legislations out in public domain for comments on Pillar 2. Canada has released its own statement on the digital services tax, and the European Commission has also sort of announced an upcoming or discussions on OECD releases their proposals really on the various Pillar 2 stance, which is expected, which is also again in public forum for discussion. So around the world, there has been reasonable traction on Pillar 1 and Pillar 2. Pillar 2 proposals are expected will be sort of adopted. Expectation is most countries will adopt within this year, at least some shape or form. Pillar 1, the proposals are expected to be finalized by end of 2023, but at this stage, its implementation is limited. In terms of where India stands, there are again a few stands which are very clear as elucidated by Bala. One, India is looking for some kind of an international alignment before it takes any steps of its own. That being said, some actions India has already taken. India's tax rate, anyways, the minimum tax rate of mostly companies are in the 25% tax rate, and with the phasing out of any kind of incentives, even for new manufacturing companies, there is a 17% tax rate. So India has more or less maintained above the 15% corporate tax rate stand. They have adopted the equalization levy, which talks about 2% on amounts receivable by a non-resident e-commerce operator from e-commerce supplier services. There is the significant economic presence rules applicable on a threshold of INR 20 million for sales to Indian persons or a user with a threshold of 300,000 in India. Interest limitation rules in Section 94B were introduced. And most importantly, the country by country reporting, which India has sort of mandated and intended to use as a base going forward to collect the information, determine where all the leakages are happening to ensure that the eventual Pillar 2 rules, be it GLOBE, be it STTR, do get implemented rationally and fairly. So I'll pause here, Sriram, because I've tried to give an overview of US, rest of the world and India, but hand it back over to you in case of any specific questions.
No, I think this is helpful, Nitya. This is giving you a perspective of where we are with respect to Pillar 2. And like I said, Pillar 2 is nearing its implementation stage, I would say, barring only STTR rules which are pending to be clarified. Right? So moving on to Pillar 1 and question to you, Shita. Pillar 1 is trying to introduce a concept of, or Pillar 1's intent is to introduce a concept of market-based taxation, where the market access, countries which has given market access, gets the ability to tax and get a fair amount of share, and which is supposed to or expected to eliminate unilateral, call it DSTs or equalization levy that most of the countries have tried to implement, right? Now, the question, one, it's only applicable for a few large companies greater than 20 billion euro revenue and 10% profitability. One, there are not many companies that are likely to be, coming under the radar of Pillar 1. But the question really is, with the introduction of market-based access to profitability or taxability, where do you think there can be potential conflicts that a taxpayer should be conscious of when it comes to how do you think the treaties and Pillar 1, how are they going to interact, right? Today, there are a lot of treaty benefits that are available with Pillar 1 coming in. What is the tax purely from a taxpayer perspective, what the taxpayer should be aware of? And two, what will happen to the traditional transfer pricing mechanism of FIR being the basis, risk assessments, etc. And also if you can give throw some light on, do you think some of these APAs that have already been signed, whether they can likely get impacted once Pillar 1 goes live? What should the taxpayer be aware of? The question becomes even more critical because as the rules are getting draft rules are getting notified and are available for public consultation. If you can throw some light on some of these, it will help the taxpayers to represent and provide feedback on it on a fair manner.
Yeah. Okay. All right. So thanks, Sriram, and thank you for at least having me on this seminar. It's a very interesting topic. The way I think of Pillar 1 and Pillar 2, Pillar 1 and Pillar 2 are actually not, I mean, the stage today was set for at least having a discussion and debate across 137 odd countries, simply because in the past there has been context setting by way of transfer pricing rules, which dealt with substance over form, dealing with value chain analysis, focusing on where do functions reside, where the risks are borne. And then that went a step further with the BEPS 1 action plans and the MLIs, where principal purpose test and LOB, etc., got factored in. So up until this point, before Pillar 1 and Pillar 2 were discussed, the relationship largely was seen between revenue, cost, and the profit. So if you're an entrepreneurial model, what profit should you have? If there was a profit sharing model, what profit should be left? If it's a limited risk distributor or a captive service provider, what profit should be? So the relationship between profit and how much tax you pay was not fully scoped in whatever had been developed whatever has been developed till date under the transfer pricing framework. So according to me, what Pillar 1 and Pillar 2 do in tandem is actually say that what is the fair share of profits that need to be allocated to this country. So it has gone, and then a fair share of taxation, which is the minimum taxation. So it is now really taking the last limb, which is the profit and taxation, and bringing it all together. And what it does, therefore, is that it is a great level playing field. In transfer pricing, one could argue that, this is a new business model, and there was a lot of scope for ambiguity to say, no, the value resides here or the risk reside there. And there was ways to model that. But with this, which is much more formulaic, much more prescriptive, there is little headroom so it becomes a level playing field across business models, because other than the carved exceptions of Pillar 1 and Pillar 2 and the industries that are not covered, etc., across models, there will be a certain taxation that one will end up paying in a certain jurisdiction and a certain kind of profits that will end up getting allocated. So does transfer pricing become redundant in this whole scenario? So that was one of the questions you raised. I don't think transfer pricing will still become redundant, because in fact, transfer pricing will now have to be reviewed once companies run their models in Pillar 1 and Pillar 2. And I think Pillar 2 is something that companies are working with much more because it's more imminent. Although in the scheme of things, grand scheme of things, the sequence could have been Pillar 1 and then Pillar 2, because the way it's actually meant to work is that Pillar 1 profits will be adjusted in Pillar 2 computations of Globe ETR or the jurisdictional ETR. Similarly, subject to tax rules, whatever adjustments are made there will be included for the Pillar 2 computations. So Pillar 2 was meant to be done once the 2 had been implemented, but the sequence, I think, natural sequence that may end up being is Pillar 2 coming before Pillar 1. So now once companies model their Pillar 2, which is easier to model, I think, from SAP, one can draw data, do the de minimis thresholds, make adjustments, book to tax adjustments to profit and covered taxes. After that, the question is that how does one deal with, does it mean that, now there's no more room for transfer pricing? No, Pillar 1 is a fair share of profit. So if you're a decentralized entity, let us say, which actually has entrepreneurs across the various markets, versus a model where there is a principal structure with limited risk service providers across the world, the two structures are very, very different. And in an entrepreneurial model, one could argue that there should be no headroom now for further allocating any more residual profits. Now, it is possible that when one runs the model under Pillar 1, there could end up being still a profit allocation to an entrepreneurial country. And it is possible that one entrepreneurial country, simply because it's formula based, and the formula has certain biases. So if you've read the formulas carefully in Pillar 1, countries with lower payroll costs and lower depreciation and tangible assets could end up in theory, subject to all things being equal, end up being relieving jurisdictions. So there could be two entrepreneurial market jurisdictions, and one market jurisdiction performing the same function, same access, market access, could end up being a relieving jurisdiction, and another entrepreneurial market jurisdiction could end up being a receiving jurisdiction. So it could be unfair in that sense. So the fair allocation, and I think that's why Pillar 1 is taking time, because a lot of exceptions and perhaps iterations will need to happen before this ideal of fair share of taxation kind of, we get to that. So I think transfer pricing will still play a part in leading those iterations, in proving that the results that are actually coming up as per the model, whatever results models are throwing up, are absurd in some sense. If they are, I mean, I'm not saying they'll always be absurd. So I think one will have to see its interplay. So that's one. And the other questions around Pillar 1 and Pillar 2, in my point of view, is that there will end up having to be so transfer pricing lend a lot of consistency across jurisdictions because of the OECD framework. Even though some countries chose to depart from the OECD, like Brazil, big departure from the OECD framework because of the rules, the way the rules are. India has some departures, but largely also aligned, right? So there are jurisdictions everywhere in the spectrum. But with Pillar 1 and how Pillar 1, Pillar 2 will need domestic legislation to progress, is there will need to be a lot of uniformity and consistency in legislations across jurisdictions, because that is the only way collaboration and dispute resolution will happen. Otherwise, there could be a lot of disputes that could arise simply because countries, like Nitya said, India is not yet having its own legislation on Pillar 2, whereas some countries have already made advances and introduced legislations. But India is a signatory to the common approach, which means that if there is a Indian headquartered multinational that is operating in other jurisdictions, India will still need to respect their application of a Pillar 2 rule if they've come up with something. And then next you asked me a question, Sriram, on APAs. What will happen to APAs that have got negotiated? Will they undergo a change or not? I'm not sure the answer is a clear yes there, because the APAs are still being negotiated, largely driven by the functional assets and risk analysis framework. And what Pillar 1 is doing is adding another dimension of which is going beyond value. So one could say that intangibles in the transfer pricing framework, your marketing activities or intangibles were value drivers. Here it's saying, it doesn't matter where your marketing activities and R&Ds, here is where the consumer is. And the consumer is traditionally, and even now, not regarded as a value driver, but a profit or a revenue generator. What will you do with all their R&D and IT backbone and marketing activities if you didn't have a large consumer base? So that's the reason why some of the developed world, which has large population bases, is a big market for a lot of the multinationals. So this concept is not yet embedded in our APS. And since Pillar 1, Pillar 2 by very nature are very formulaic, very prescriptive, with obviously room for some interpretation here and there, I don't think it is so obvious in the short term. But what is very important, and I think governments are realizing, is that the pending APA backlog has to be cleared up, because that will enable companies to do their Pillar 2 computations much more correctly. Because all of this is linked. What happens in Pillar 1 goes into Pillar 2 computations. And if there is a big jerks coming along at MNC's results because an APA got decided one way, whereas the transfer pricing was another way, and suddenly there is a big tax expense that you're recording in the year that the APA get resolved, or a big income that you're recording. Results, obviously there are some rules in the globe rules as well which provide for how the past adjustments have to be treated, if they're upward adjustment or a downward adjustment. So it is clearly much neater if a lot of APAs get resolved, and a lot more transparency, a lot more dispute resolution around transfer pricing happens faster. So these are my initial thoughts. Of course, one will see how it all pans out, but if I were to crystal ball gaze, I would think that more capacity building, clearing of backlogs, and companies building their models fairly nicely to see how these will all interplay. And once the results come, there may be a room for, again, more dialogue and discussion among the inclusive country, the framework countries, to say, do we need to change something here? After it gets implemented, of course. So sure. I should pause here, yeah, and then see if you have more questions.
No, absolutely. I think we need to continue to watch out for as the pillar one emerges, because, like I said, it's going to be a structure which would come up with a lot of intricacies, which will come up with a lot of interplays that we need to watch out for in the traditional way of administering taxes and collecting tax. Moving on to you, I have a question on pillar 2, again specific to pillar 2. What do you think is the preparedness of companies in India which are part of a M&E group with respect to implementing pillar 2? Now that countries have started, especially Europe has started, amending their domestic laws to bring in pillar 2 implementation. So what in your view is the preparedness of the companies? That's point number 1. And point number 2, what are the things that the members who are part of this call need to watch out for if what's coming their way in terms of pillar 2 implementation?
Sure, thanks, Shriram. I think I'll answer the question in terms of both the outbound MNEs and the inbound MNCs. And we have to keep in mind that in both cases, the revenue threshold, which is where pillar 2 does become applicable. I mean, it's a fairly high threshold right now. So there would be a very handful of a few companies, which would be subject to these rules in the first place. But on the assumption that we are talking about those companies to whom these rules apply, and if we are an India outbound MNE, it would be good to look at the pillar 1, pillar 2 proposals, particularly pillar 2 proposals in a bit of a fine-tuned detail, because we are talking about multi-layer proposals, right? We're talking about globe, we're talking about STTR, we're talking about income inclusion rules. So how those rules sort of play into the overall taxing rights for India. And again, bear in mind that India is a country which is applying a minimum tax rate, has sort of subscribed to the minimum tax rate of 15% already. So what exists outside the scope of this for allocation amidst the various taxing rights under pillar 2, personally, if you ask me, I would say it's limited. Pillar 1 may have more scope for allocation, but pillar 2 for an outbound may be limited, is my personal view at this stage. From an inbound multinational side, I think there are few things that we can immediately assess. One, the significant economic presence. The rules are in place, and a lot of our companies which are doing business in India, there is a compliance obligation that has been cast. So going back to the basics in terms of determining whether or not a permanent establishment exists under the existing laws, and if yes, then the call that needs to be made, which is, are we then doing the compliance in India? Similar decision for significant economic presence, that is the business today in India meeting the minimum threshold norms which has been subscribed in the law, and if yes, then whether or to what extent the compliance needs to be made. The provisions for compliance have to be sort of, I would say, institutionalized in that foreign company. A third angle that has been looked at in my company, if you see, is realigned segmentation. So today, business units are categorized in a certain way. Very specific to my industry, perhaps, is that the service component which relates to that medical equipment is characterized along with the sale of the equipment itself. One of the conversations that we are having is that because service today is such a fast growing segment of the business, whether it needs to be separately segmented in itself. But the angle that has been brought about thanks to, these pillar 1, pillar 2 conversations, because a lot of service happens digitally. I mean, in theory, a person sitting in India can have a problem, let's say in the ultrasound equipment software, and call up somebody in, I don't know, US and get a resolution. So you may actually see a lot of services happen even in such a complicated medical equipment industry through the digital means. Now, how would that work out from a, under these new laws? What is the kind of taxation or the methodology that needs to be adopted? So larger conversations of business will probably need to be conducted, keeping in mind these tax proposals, which are already either happened or happening, and to that extent, a little level of detailing or understanding on how a specific proposal, sort of impacts on that business proposal. There is also this large initiative that has happened under the PLI, and we are looking at a lot of companies in India for global multinationals acting as export hubs. So we are saying that now India will act as a export hub for manufacturing in the whole China Plus One strategy. The entire pillar 1, pillar 2 conversations are driven by market access, right? That's been the fundamental story so far. But what we are saying now is India is not manufacturing only for India. India is manufacturing for the world. In that case, the fundamental logics of, allocating taxing rights on the basis of market will require some level of maybe rethink or evaluation, because what we are producing now is not just for India. We are producing, for the world. Lastly, but definitely not the least, as has been pointed out by Shikhar also, the principle that India has followed till now is that we are not going to act unilaterally or adversarially. We are going to wait and see how this entire sort of negotiation and alignment plays out. So from a company point of view, whether or how we engage with government bodies, with institutions such as BCIC, because ultimately our challenges are very unique, very inherent to us. So where we see these taxing proposals impacting our business, it's important, I think, for companies to come up and now present it in forums like this with very specific, I would say, numbers and specific case studies to show that, let's say, an equalization levy, or let's say a significant economic presence across countries is interplaying in maybe delivering a result which was not what either government had intended for. And including in this, I would say, the compliance obligations, which do tend to add more from a cost of doing business in India perspective. So these are some of the things, Sriram, that I would recommend to us as an industry body, us as companies, to watch out for and think over as this progresses over the next few months.
No, very valuable input, Shikhar. Thanks for that. Shikhar, moving on to you. Amount A and Amount B under Pillar 1 is whole concept of attributing profitability to multiple countries, right? When a certain amount of tax profitability gets distributed to multiple countries, as a taxpayer, what are the kind of administrative issues that you envisage, right? Which OECD has to keep in mind and the governments have to keep in mind to ensure the taxpayer doesn't suffer in the whole allocation of these profits. Once I hear your views on that, I have a follow-up question.
Yeah. Okay. So, so I think there are administrative aspects for which the guidance was released in July 23 for Pillar 2. But on Pillar 1, since your question was focused on Pillar 1, the administrative questions that currently can be raised, and I think they will have to really be figured out, is that Pillar 1 can actually lead to a crisscross of payments. So let's say an M&E is operating across 30 jurisdictions. I'm just taking a random number. So jurisdiction 1 paying to jurisdiction 4, jurisdiction 5 paying to jurisdiction 8, and so on and so forth. So there could be a real crisscross happening. And an amount, a relieving amount would be computed, and that relieving amount would be paid by the relieving jurisdiction's tax authority hopefully, and not by the taxpayer, to the receiving jurisdiction. Now, there will be foreign exchange fluctuations. So who will take the risk of that? Is, I think, one question. And I think some of these are being worked through with OECD, but we don't know where the answer will end. Does it mean that all MNEs will need to have a clearinghouse entity where all these payments would first be accumulated and then be disbursed? That is, one is just around payments and how they're going to reach the receiving country's government. Second is that how will double taxation relief be granted on the books? So if, let's say, an Indian entity has ended up paying to an Egyptian entity, so Indian entity is the relieving entity and the Egyptian entity is the receiving entity, then on the books, when this payment is made, how will it actually be accounted for in the books? And what impact will it actually then have on, such that in the Pillar 2 framework, when the globe rules are, the globe computation is being taken into account, this comes up into the consideration. This adjustment comes up into the consideration, and so that there is no ambiguity at that point. So I think these are some very initial thoughts and questions. The other question, which I think, which is maybe less important for everyone, but important for certain companies, like if I were to take an example of a relieving country, which is publicly held, it has some minority shareholding, and let's say this entity has to it's all jurisdictional actually, but let's say there is only one entity, and this is held by minority, and the amount that it needs to relieve is 100, and it is held 60% by promoter, 40% by minority. Then can there be a question that the entire 100 has been determined basis the group's workings? So why should the 40% minority shareholders suffer because of this payment? Or will it get neutralized? How does it get neutralized? So some of those things, because there are larger questions that when you do JV and associate accounting, it's an equity method. It's not a line by line consolidation. But if it's held by the minorities and it has some promoter shareholding, then it is a line by line consolidation. So clearly in Pillar 2, for instance, the equity method entities, associates and JVs are outside the purview. They do not have to be included by the ultimate parent entity. So I think some of these things companies are still working through. There are no obvious answers, and there will end up being some administratively convenient answer so that things can continue flowing. But that is still a guidance that all the countries together in the administrative draft dealing with administrative issues will need to come up with. And that is why Pillar 1 has the whole acknowledgement of these rules, how amount A and amount B are being determined, and then also the larger admin issues. I hope I was able to. Yeah.
If I may add to what you just said, very well said, by the way, just on the administrative and technical part, I think tax credits will become a very relevant issue going forward. As a group, which tax credit in which location has to be sort of offset, its calculation, retention, and then eventual claim, and the attendant methodology for the claim. Compliance will be a key part of claiming of credit, right? I think that will also be a very important factor to look out for as this evolves.
Excellent. And Nitya and Shikha, to both of you, with all these complexities and for a taxpayer, what do you think are going to be the new kind of disputes that are going to arise? Again, very high level, first-hand view of what are the likely disputes, especially when you're going to allocate revenues across profits across multiple countries. What are the new issues the taxpayer should be prepared for? And like I said, it's very early to comment on because it's still evolving. But with the amount of complexity that this is bringing in, and both in terms of companies as well in terms of different governments taking different views in terms of whether India's views are heard, where is US on all this. One, from a taxpayer perspective, from the way I see it, the disputes are going to go up. So what are the new kind of disputes that we need to brace ourselves for? If you have any initial thoughts on it. Shikha first, and then Nitya, if you have any thoughts on that.
Yeah. So, by very nature, since this is a very multilateral initiative, currently our dispute resolution is more geared towards bilateral, unilateral. I mean, of course, there are provisions for multilateral dispute resolutions, but not multilateral at this scale, right? It's multilateral at scale of 1 to 3, 1 to 4, if at all, exceptional. So what this first of all entails, and that is obviously a worry in the industry, and this is still being worked out. I mean, this has to be worked out as to how do. So let's say take an example of pillar 2 computations. Pillar 2 computations, it's very clear, will happen as per the books of accounts of the ultimate parent entity, as per the financial year that they follow. Now, clearly, all the other jurisdictions do not follow that financial year, do not follow the same gap. Accounting gap. So there is at least some guidance that your starting point is the ultimate parent entity's gap and year. But so there will of course be differences from what is jurisdictionally reported and what you're going to compute under pillar 2. That is number one. So obviously one will, but the good thing about pillar 2 is that whatever you compute, pillar 2 is whatever you compute, it actually by and large will be paid as a top-up tax under the income inclusion rule. I mean, unless it's already got taxed under subject to tax and in other avenues, or qualified, under a top-up tax that domestically has got introduced in any of those countries. Ultimately, whatever is left under the income inclusion rule will get paid in the ultimate, the jurisdiction where the ultimate parent entity is located. So I actually feel that there is little less scope for dispute in pillar 2, because you are using the parent entity's accounts, parent entity's financial year, and all the computations are around that. Now there could be challenges around how have the book to tax conversions been done and explaining that, but that is get normalized and fairly standard over a period of time. I do think there's more chances of disputes under pillar 1, because pillar 1, when the model runs, then there are a lot of issues, and when pillar 1 begins to interplay with pillar 2, which is really the last ultimate end state of it all, pillar 1, pillar 2 both implemented, that's when I think things will become quite complicated. Because countries may argue, why am I the relieving country when this is an entrepreneurial model under transfer pricing, and what has actually been used, why is it? So one will have to really then really explain the entire model, because this whole working cannot happen unless the entire model is shown to each country, socialized with that. So I think there will have to be administrative capacity built in all countries which are completely conversant with how this works, and this will be a learning curve. This is a learning curve for tax departments in the companies. This will be a learning curve for administrations. For sure, tax departments and the companies are going to be far more, because currently these activities are run by a handful of people, be it advisory firms, be it in companies, be it the government level, right? So socializing that across and it becoming the new normal, if it's all implemented, is so that's the time when all of this will really come to question. So I think pillar 1, according to me, is going to be a much more disputed area. I mean, once everybody signs off on how the formula works and everything. So therefore, I feel there is a very, very serious responsibilities on all the countries to protect their interests and to think of all the possibilities that can happen. Like currently, I think in pillar 1, there is a lot of emphasis on domestic business carve out, which means that if you are, let's say, operating in a certain country and you have been identified under the model rules, the computation, as a relieving country, but you are making residual profit because your market access, your consumer base is here, then and then subject to a few tests or checks, you cannot be identified as a relieving country. You should be taken out of the whole tiering exercise. So there will be carve-outs like that. So I think once all these carve-outs, so there will be a lot of understanding and collaboration right at this stage, because once it's implemented, the idea is that everybody signs up to what the formula throws up, and then it's a matter of explaining to each tax jurisdiction how that tax jurisdiction has ended up being a receiving or a relieving jurisdiction. That's my point of view. I don't know if I addressed the question, but I've certainly spoken my mind on this one.
No, that's very helpful, Shikha. And any remarks from you, Nithya, on this?
So I see two things, Sriram. One, again, the threshold of revenue is such that there are not too many companies which at least initially will be impacted. So maybe from a scope of dispute resolution, the universe will be smaller at this stage. Secondly, and I think Shikha said all the points very well, but maybe just to add one additional point. Traditionally, the scope of dispute has been taxpayer versus the government of that country. Now the evolution, I think, is going to be government of one country with government of the other one or two or three countries, over which that multinational group is operating. So you will see a lot more government to government exchange and more across the table settlements at a governmental level. Again, something Vala had alluded to, right? The exchange of information between governments is increasing now, and that will probably set the stage for dispute resolution under pillar 1, pillar 2 also, where the government will definitely hear the taxpayer say in India and say, okay, we heard you, but we want to see the bigger picture. We want to see, what is happening across the board in this company. So yes, then the conversations with the other government sort of will start and engage. So my sense is that will be the natural evolution in the dispute resolution as pillar 1 and pillar 2 evolves.
Excellent. I think that's very useful, Shikha and Nitya. And like I said, this is still evolving, and all of us are talking from what we know so far. And I'm pretty sure with respect to pillar 1, what we know is much lesser than what we ought to know, right? So next few months, as the rules become clear, as some of these things get notified by OECD after 130 countries come on board, hopefully with US coming on board, right? This will evolve. I mean, as a closing remark, I would say December 23 sounds very ambitious for Pillar 1, considering where we are with some of these very fundamental questions still open. So December 23, in my personal view, may not be it's not even ambitious, it's beyond ambitious, right? But one thing is for sure, the coming months as to how this is going to evolve, how larger countries, both from the developing side, developing countries like India, and how a developed nation as US is going to now drive this whole model, will probably determine where the whole pillar 1 goes. And like I think I've heard it multiple times from many panelists, the whole pillar 1, pillar 2, the sequence was supposed to be 1 and then 2, but with 1 being as complex as it can get, with so many countries getting into picture, pillar 2 being only the minimum tax rate has gone ahead of pillar 1, while the sequencing should have been the other way around. But that being said, we are where we are, and I would like to probably conclude here saying that let's wait and watch how pillar 1 emerges, and then probably then as corporates and taxpayers, be prepared to either you're a part of a larger M&E which is in pillar 1 or larger M&E yourself, right? As to what are the preparedness, what are the documentations, and what are the teams that we need to build to handle such complexities. I know I would take this opportunity to thank both Shikha and Nitya for joining on a Saturday evening and sharing your thoughts on a very critical topic as when it comes to international taxation. Thank you so much for your views. Back to you, Sunil.
Thank you.
Thank you, Sriram. Thanks, Shikha. Thanks, Nitya. We'll move to the next session on today, which is on startup issues on angel tax and migration to India. I have two esteemed and distinguished panelists who I'd like to introduce. We have Pallavi, single partner with Pricewaterhouse. She's has over 23 years of experience in tax and regulatory matters, cutting across international corporate tax, foreign inbound and outbound investment and exchange control laws. She advises clients on cross-border operations, tax structuring, tax advocacy, litigation, and controversy strategies. She also provides core tax advice for inbound and outbound cross-border transactions on very challenging tax issues, including tax advocacy and litigation. She also writes for various publications, international periodicals. Thanks, Pallavi, for joining on the panel today. Along with Pallavi, we have Rohit Jain, partner at BSR. Rohit is a law graduate from the University of Mumbai and a fellow member of ICI, a unique combination of having done, chartered accountancy and law. He's advised various Fortune 500 companies and Indian conglomerates in sectors across financial services, manufacturing, telecom, oil and gas, and on smooth transitions also from the sales tax to the VAT regime. He's been involved in making representations to the Ministry of Finance and Ministry of Commerce in relation to various tax policy matters on behalf of numerous associations, and has also specialized both in advisory and litigation matters. Thank you, Rohit, for joining the panel today. What I'll do is I will do a short kind of an introduction on the topic. This is a very hot topic, especially from Bangalore is concerned. And then, we will go over a few points of views which, both Pallavi and Rohit, can share on this topic. So let me just get started with a short presentation. I hope this is visible. Is this visible? Pallavi, Rohit, can you guys see this? Is the presentation visible to all?
It's visible, Mr. Sunil.
Visible.
Oh, fine. Yeah. So just a short, to start with, what we would call as angel investors. I think most people, are anyway aware of this. It's what we would call as the initial seed capital that individuals would invest in a startup or an initial entity in return for an equity. And some trivia around here. The application of the term angel actually originates from a Broadway theater, where it was used to describe wealthy individuals who actually would provide money for theatrical productions that would otherwise, would be shutting down. So that's really where this term of angel investors, has come from. This section was actually introduced way back in 2012 and was seeking to tax excess premium that was received by closely held companies when they had issued shares. And this income was actually taxed under the section of income from other sources. And the intent back then was to discourage, black money or money laundering activities in terms of, passing it on to existing shareholders without having a real backup of the value for which, these investments were being made. The excess premium was computed using a deemed income, and tax liability was arrived at between what was the FMV of the company shares and the amount invested. There were only two, methods which were there previously. And now coming to the amendment that was made recently in 23, this was previously applicable only to residents. And then this amendment now brings in even foreign investors or non-residents into this ambit. If you were to look at largely, how this is pre and post, like I just mentioned previously, it was only for resident investors. It's now applicable to non-residents as well. The valuation methodology, which were only two, now have been expanded to over 5. There were certain exclusions. Startups which were registered with DPIIT were excluded from this angel tax. Now, while it's applicable to non-residents investors as well, certain specified nations have been excluded, to which this angel tax would not apply. Earlier, there was no safe harbor rule. Now there is a safe harbor of 10% for both resident and non-resident investors. And in terms of documentation, there's been a change which says that 90 days is the specified time period of validity of any valuation report. So essentially, these are the main things that in terms of the section and the amendments that have been made. So let me now get Pallavi and Rohit into this discussion. If you were actually to look at this particular issue, which we call as the angel tax, and this has been something which has been an issue which the startup industry has been raising for quite a few years. In fact, even from 2012. And there were two concerns which were there. One was, is this something that is reasonable? Is it fair? And the other issue was in terms of this being a it was not a level playing field. This was applicable only to residents. And the concern was, why would a non-resident, get a benefit of not being taxed similarly? And this is in fact a penal, kind of a way of discouraging Indian, wealthy individuals from investing in startups and encouraging, startups in India. So I'm not very sure whether, bringing this amendment by including the non-residents in its ambit, is this like, two wrongs trying to make it right? So let me, start off with you, Rohit, in terms of where do what's your initial comments? Does this actually make it a level playing field? Because there are certain still inconsistencies. Certain, countries have been exempted. And does this further accentuate the issue for Indian startups? So your initial comments on how do you see this from a investor's perspective as well as from the startup entity itself?
Yeah, so thanks, Sunil. As I see here, there are two questions here. One is from an investor's perspective, how do you see this balancing out between residents and non-residents? And the other piece is what impact it has on the Indian investee companies. Now, if you ask me, difference between resident and non-resident investors, the rules were always separate for both. You always had the FEMA provisions and probably transfer pricing provisions also applying to non-residents, which were never applicable to Indian investors. And as you rightly put out, even today, if you see the draft rules that have come out or the exemptions that have been given, still there is a difference in terms of different provisions that apply to a resident as well as non-resident investors. So as you mentioned, for non-residents, we do have additional 5 valuation methods that have been prescribed, which have not been made applicable for resident investors. So I would say, looking at this lens, as you also put it out, first of all, taxing a capital transaction as a revenue itself is an inconsistent and not a good starting point. And trying to balance it out and trying to argue that let me have 2 crosses, which will arguably balance it out and make a right, is not the way I would look at it. Rather, my better perspective would have been that had they eased out the provisions for resident investors, that would have been a better way to balance things out. They just operate on 2 different spheres, I would say. The other part of your question, how does it impact the Indian investee companies? I think it does really create more issues for them, especially at a time when you're looking at a difficult patch in terms of raising funds, and when the country is also looking at more and more FDI. I think today where we stand, we have far more better checks and balances in place in terms of FEMA provisions or disclosures or the data that is available with the government. And I think a better view would have been to tone down the existing provisions rather than bringing in this new requirement. And if you see the way different requirements will pan out, both from a corporate law or a FEMA or a tax perspective, ultimately it's now the value who's rather becoming a kingmaker, and in terms of the processes, there'll be much more rigor that will be required, much more time would be required for coming out of final pricing and raising funds. And of course, you will also have this additional overhang of a potential revenue audit that may trigger if you receive investments from a non-residents. One more point I would say, to watch out for is any update to existing instruments that are outstanding, or any form of corporate restructuring that an Indian company may go through may have this additional, rigor to be tested in a case where you have non-resident investors. So certainly, this could have been done in a better manner. Maybe Pallavi, if you have any more comments on this.
Yeah. So while I get Pallavi on, Pallavi, just in addition to what Rohit had, had commented, along with that, if you look back, this was when it was done in 2012. It was more of a specific anti-avoidance. We didn't have, GAR at that point in time. Now with new rules, it was this something which was, antiquated, which really is it necessary? The tax authorities do have enough in their armory to kind of question, transactions. And does this amendment also in some ways, bring in invoking transfer pricing, provisions, etc.? So if you could just cover that as well while you respond.
Yeah, thanks, Sunil, and thanks, Rohit. The only additional point, Rohit, on the point you make very rightly so, that it doesn't really still provide a level playing field, because there was enough and more already to monitor, if for lack of a better word, the non-resident investors, particularly as you recall, AIFs are exempt from this. So to that extent, individual and corporate non-resident investors will still be on the downside in this context. 2012 was when GAR regulations were being conceptualized, while it finally found its way into the Indian tax code in 2017. And we've not seen so much, luckily, fingers crossed, practical application of the GAR legislation in the draconian form that it can be applied. As we all know, this is a broader regulation. This is to counter potential tax avoidance and evasion arrangements. SAR, of course, is more specific. It is for known arrangements. So I would generally lay my bet on valuations getting covered by SAR. Now, how should be the framework of that SAR, of course, is debatable. But it's better that specific valuation related adjustments are done through a specific applied code. Transfer pricing, yes, it talks about the arm's length criteria. We'll all remember the Bombay High Court ruling in context of Vodafone, where they clearly held that issue of shares is outside of TP rigors. Of course, from a reporting standpoint, purely from a conservative compliance standpoint, we still do report it. But technically, one always can take a view that this is not subject to transfer pricing. I personally do believe that perhaps there is a dichotomy. I know many councils subscribe to this view. Of course, it's blessed by the court as well. But Levin UA should be good for TP. To my mind, the arm's length criteria gets defeated. What is a transfer pricing principle is what gets internationally accepted. What is the principle to apply across? And therefore, if one just takes FMV, whether that ordinarily is fine from a TP perspective, could be perhaps a very aggressive defense to take. I again would like to reiterate, it's better to cover valuation guidelines under a SAR, just as we implemented TP to look at all cross-border transactions. Leaving it to GAR would have been completely chaotic.
Okay. I think so. Your view is that we should keep it outside of GAR and have it specifically addressed. The way TP has specific rules in terms of how do you look at arm's length with different methodologies that are prescribed. Your view is that something similar, which is what is possibly envisaged with some additional valuation methodologies that have been prescribed, kind of then ring fences this whole arrangement rather than keeping it completely open to any kind of an interpretation. So I guess that kind of is a segue to really the core of this particular issue. If you look at it from every aspect, it really boils down to a valuation, and that's where a difference of view between what the investor or the startup has in its mind as to what its value is versus what the revenue thinks is the value, is where the whole gap arises, and therefore disputes that will arise. So Rohit, from a valuation perspective, now in my mind, valuation is both an art and a science. I don't think there is really a framework of rules that can determine it, while there can be indicators towards that. Because if you look at from a real valuation, and especially from a startup perspective, you really never know whether the startup will eventually succeed and at what level of growth it will have. Not everyone turns out to be unicorn, right? That's how the startup world is. There are more failures, if I can say, than successes. And therefore, investors, really take a bet or a risk in terms of when they really invest into an initial startup. And they do take factors as dilution rights, liquidation preferences, etc. And now with the new rules that have come in under Rule 11A, three additional methodologies that have been prescribed. Do you really think that these are helpful, and would this address the concerns of a non-resident investor on the way valuations would be looked at, and that would be considered as fair from an Indian tax authority's perspective?
Yeah, so I would say, these, if you look at these new rules that have been, the new methods rather, that have been outlined for non-resident investors, they do, take into account some of these aspects, and, those are the methodologies that typically apply to an early stage company. And, these options may provide some flexibility in terms of making adjustments for some of the issues or specific differences in rights, etc., that we typically see in the startup world. Now, having said that, and as you also alluded to, what we would love to see more is some more guidance on some of these valuation methodologies, which would try and take away some of the I would say the difficulties that people may have in terms of interpreting them or applying them on either sides. The other aspect I would say is, I would say this is just a beginning, and government should ideally keep this list in an evolving model, because as we go through different rounds of audits, or as we progress through this thing, there will be newer things that will come into the picture, and ideally, towards, if you see the extreme side of it, the best would have been to keep it consistent with FEMA provisions, where you just call out any internationally accepted method as being acceptable here. The other thing I would like to call out here is, while I touched upon the guidance part of it, is the whole issue around implementation. So at some stage, having expert officers looking at valuation matters who are trained on some of these methodologies would also would be a good way to give some comfort to the industry here.
Yeah. Thanks, Rohit. So, Pallavi, your thoughts on that, and how do you also see this? You have valuations under FEMA. How do you kind of reconcile the two, and any challenges that you see under the valuation methodology that you have, under Section 56 as well, and the angel tax provisions?
Thanks, Sunil. So you cover very interesting 3 points. One is standalone valuation, which Rohit also alluded to, and the challenges around that. The interplay with FEMA, where there is a prescribed minimum threshold methodology already provided, and how it interplays with 56.210. Now, various methodologies, whether it's the prescribed probability weighted expected return method or the option pricing method, etc., they are based on 2 aspects. One is the math and the science of the methodologies and the assumptions that they take. And 2 is the projections, the actual versus real projections of any company. What it misses is various scenarios or nitty-gritties which perhaps could be relevant. For example, conviction of a founder, his track record, the experience of the person funding in similar sectors, and various other macroeconomic factors. I remember, Sunil, I was in a earlier discussion with one of your ex-colleagues, Mohandas Pai, and he was saying that while we can drill down to any level of assumptions in a valuation, what happens in that closed room between an investor and a startup is completely a different ballgame. Take gaming sector, just for example. The valuations will be hit by the GST rule, known. But what exactly is a negotiation that actually goes in beyond the math and the tax impact that has been factored is something completely different. EduTech sector completely hit in context of the pandemic. And now when the world is coming back to normal, it's again a different ballgame. So therefore, is our methodology appropriate? Will that be accepted by the revenue officers here in India? Will that be internationally accepted? Is our 10% safe harbor threshold fair? It's anybody's guess. Also, in context of FEMA, the whole thrust, if we recall, for the insertion of this angel tax is excessive share premium, not backed by a proper valuation. However, under FEMA, they mandate that non-resident investors should be issued shares at a price not less than the value that is internationally accepted. So FEMA regulations stipulate a minimum price at which an investment is to be made. However, one wants to marry the two. The simple thing is DCF valuation should be opted for. And that is what is currently prevalently followed as well. However, interestingly, these rules, and while of course it's still in the draft form issued for public comments, it permits a lot of tagging. If one is to issue shares following one methodology, say to an FPI or a government agency, the same valuation may be relied or applied from to a varied investor base. And that, to my mind, is a very big advantage. The second advantage is it shows the government's thinking to be open to or adopt newer methodologies beyond the currently prevalent DCF. So I think in that context, while there will always be subjectivity in implementation, these are two very good takeaways from the rules that have come by. On the aspect of how does one align with 56 to 10, it's evident that the valuation in context of an investor, 56 to 10, if you may recall, is from the perspective of an investor where they needed to tax anything which is less than the FMV. And FMV was defined to be simply adjusted book value. And in this context, you are seeking to tax the premium that is paid. So the valuation methodologies under both the provisions are different, and therefore it could be possible that the excess amount received, which is income from other sources in the hands of the issuing company, may not be the same as the amount which is lesser than the FMV in context of the investor company. So there could possibly be a dual taxation, and that should be the only challenge. We should be able to understand that the intent of 56 as a whole will stand defeated if there is such a contradiction. So I believe that some kind of resolution, whether that comes in the form of a notification or any kind of press release, where there is a redressal to this contradiction would definitely be welcome. Maybe one can bring it in the form of some kind of safe harbor or validity of the valuation reports being considered. I mean, these are just a couple of thoughts.
Yeah, very interesting points that you made, Pallavi, because I think there are various, sections within the income tax, or if you look at other regulations, they may not be looking to be aligned when you look at these valuations. And therefore, for companies, it does become challenging in terms of, what's that right valuation, which they think is, will meet all requirements, if I can say that, or do we work with a range, which is where, this whole thing of about a range which kind of works for multiple rules or regulations, would meet things. So I think it's something that I think we need to see how this will evolve. Really, the purpose was to see if this could have been reduced. but looks like we'll have more discussions around this. So just staying on with you, Pallavi, I think given that the angel tax rules have been around for about 10 years, it'll be interesting to kind of get to know from you, what's the kind of litigations that we've seen around this matter. And you see that, in some ways coming down or, increasing, from these amendments that have been made. So some of your views will be helpful, and then possibly to get Rohit's input as well on that.
So yes, I mean, angel tax, as you rightly said, firstly is all about valuation. It's simply that getting that right, which is critical to not getting taxed on the premium. The question on valuation getting tested is always affirmative. It is tested standalone. It is tested under the guise of income tax transfer pricing provisions. Basically, like DCF model was always being followed, and the same would get into revenue audit 2 to 3 years post the share issue. So the comparison of actuals versus the projections at the time of valuation was always a challenge. We've seen, thankfully, a lot of favorable tribunals where the tribunals have ruled that actuals are not to be looked at. So true up need not be done because expert opinions of a valuer at the time of valuation cannot be disregarded. But we all know till the apex court doesn't rules on it, this matter will not be settled. Another issue always was the choice of the valuation methodology. While the rule provides that choice to the taxpayer, like we have seen historically in the context of transfer pricing, tax authorities challenge it, or they use net asset value. I mean, while we may choose to use a DCF methodology to compute the differential amount and subject it to tax. Most countries, to my understanding, do not impose significant restrictions around capital flows, and hence valuations are not significantly questioned. However, they will find way to get questioned under specific valuation methodologies under a SAR or even under GAR. It's not that if it's covered under a SAR, one cannot question it under GAR or under transfer pricing. My only take here is that when we did have non-residents being subjected to FEMA, also they are flowing this money through proper banking channels. You had an AD banker also who was questioning it. Today, treaty benefits also, thanks to MLI, principal purpose test, all of it being tested, or even beneficial owner for most of these passive incomes, as well as issuance of shares, etc., the registered owner versus passive beneficial owner getting tested. Why do we specifically again need to have a valuation methodology, bring in this particular amendment and cause more conflict? I do believe that this is a very aggressive stand.
Thanks, Pallavi. Rohit, any views, any inputs on what you're seeing around litigations and any thoughts you have in terms of how do we kind of mitigate this, for taxpayers? You're on mute, Rohit.
Sorry. I think on the points of litigation, Pallavi fairly covered what we are seeing. No, my only comment additionally would be, when these provisions were inserted, the idea was to check flow of unaccounted money and bring them to books. Somehow over a period, we have lost focus on that aspect and moved on to valuations today. As Pallavi rightly put out, you have so many new checks and balances that have evolved over a period of time now. So, I mean, is there a real need for such a kind of a provision where you are taxing capital as revenue? Now, having said this, we are where we are, and if you ask me in terms of what companies should be prepared for, I would say, having a very robust and strong valuation report with thorough numbers as backups is the first priority, I would say. And in the valuation reports, the valuation methodology that is getting chosen. The reasons for that should be very properly documented. Additionally, any methods that are not being applied should also be, ironed out why some of these methods are not relevant in this case. What I would also suggest is doing a 360-degree review of all the past valuations that the company has gone through and validate those valuations with current set of actual performance. And lastly, if possible, try and validate your valuation through multiple methods. I know it may not be practical possible in most of the cases, but as a backup, just have that argument also in place. This is from the number side of it. From the legal side, of course, I personally believe this space will evolve further with time. So, just keeping track of what positions are evolving, both from a statute perspective as well as, legal jurisprudence perspective, would also certainly go a long way in people to plan their defenses around this.
Thanks, Rohit. Any thoughts, Pallavi, on how taxpayers should prepare themselves?
I think Rohit covered it. I would say, just to sum up, if one gets their substance and form right in the valuation, they will be good.
Great. So if I were to kind of look at where do we go from here, especially given the current context, there are reports. There's a PwC report which says that investments in startups have actually come down by almost 33%, this year as compared to last year. There is concerns whether this would actually, start another round of startups, whether they may want to flip, from India. If you remember, that was one of the things that we've been, hearing for quite some time, where Indian startups pretty much have headquarters outside of India, Singapore and other places. So, what is your, thought on, what will this lead to? Is this amendment, going to be negative? Do you see concerns on, startups wanting to look at moving out? And do you think this was a much harsh kind of a change that the government did? And also, is there something that can be done to address concerns? While the ask from the industry has been to kind of actually remove this section, but any suggestions on what can be done to make things better? Given that my view is that the startup industry is still concerned, the way this is moving towards. Pallavi, Rohit, any of you all can take it and then follow through with the other.
So, like I did mention, I believe it was uncalled for. I believe it is aggressive, given, like Rohit rightly articulated, there are multiple checks and balances in place. It does not create a level playing field, because non-residents anyway are subjected to multiple rigors. And like I said, AIFs are exempt from it. So there is a likelihood of startups looking at other jurisdictions. I do feel that the changes in the rules appear to be an initiative towards changing the narrative that the government is open to different methodologies. Of course, whether rubber hits the road is at the revenue audit stage, and therefore the final rules and the implementation will be impacted and deflected to other jurisdictions. But even while implementing this, they could have drafted it more comprehensively. For example, exemptions. It could have been extended to simple jurisdictions like Mauritius and Singapore. So much has gone into establishing substance in Mauritius and Singapore, starting from your Azadi Bachao, TRC, the PLI, the MLI, everything. Now, again, these two jurisdictions are not covered in the exemptions. Also, the safe harbor deviation of 10% is a very simple threshold. One could have looked at something more realistic like a 20%. And the 90-day period for a valuation report. And all of us who deal with the startup fraternity know is a very tight timeline for anybody. So at least 6 to 9 months would be a more realistic one, given the manner in which the startup fraternity functions. So I think it cannot be a one size fits all. It has to be customized for specific sectors, given business and commercial rationale as well.
I think, I would tend to agree with Pallavi. This amendment does add to the woes of the sector and does add one more item, in favor of moving outside. Of course, I would say tax may not be the only driver always. So that's, but in terms of the go, no-go decision, this is one more variable that has now come into the picture. In terms of how this could be improved, again, I would tend to agree with Pallavi. Rather my suggestion would be by 20%, why not 50%? I understand some of the overseas jurisdictions do have some guidance of, either 150% or 66% kind of range. So probably that a higher starting point is what I would suggest. And of course, some clarity on how this will be implemented. It should not happen that every case where a share premium is received is picked up for an audit. So, some comfort to the sector that, this will be done only on selective basis and not across the board, would, I think, go a long way in, de-stressing some of the angst.
Yeah. Yeah, I think, I guess, Rohit, Pallavi, kind of to summarize, this is all about valuation that, like we spoke about. And I think like everything else, it eventually boils down to how the tax authorities use these rules. It is, possibly from a revenue perspective, this is helpful to ensure that, people are playing by the rule. Eventually, it is how this is, kind of used. Is this used in a draconian manner, which will then be very unfortunate. But I think at the same time, it also, puts a lot of thing on startups to have, the documentation, which anyway is necessary, but it just adds one more element of a concern, especially from an investor community in terms of whether this is an additional risk that needs to be considered, while, making investments into India. Before we sign off, I think just for everyone, I was just looking up on, angel taxes. And in fact, there is a New Jersey tax credit, possibly there's some others as well, where actually it's the reverse. The investor gets a tax credit for doing an angel investment, so I think there is a different, angle to this as well. On one side, we are looking at, angel tax as being a punitive, but there are jurisdictions where it's actually, they have their checks and balances. I wouldn't say it's without that, but there are credits or benefits given to people who are actually investing into startups and to encourage, startup investment. Thank you, Pallavi, Rohit, very much for joining this session and sharing your thoughts. I hope, for all participants, it was informative and helpful. And thank you for joining the panel today. Really appreciate it. Thank you.
Thank you.
Rupa, back to you.
Thank you very much to all the eminent speakers for making it convenient to address our session on a Saturday evening. And thanks to the leaders of the expert committee and all the participants for attending this session. Thank you once again, and we look forward to your participation at tomorrow's session also. Thank you once again.
Thank you. Thank you, everyone.
Have a great evening.
Thank you.
Thank you
very much. Thank you.
Thank you.